Learning some price action techniques and knowing about the market secrets is not enough to become a successful trader. You need to have a successful mindset, a success mindset. So in this video, I'm going to tell you 3 bullet points that you need to remember until your whole journey, because this is not a simple course. This is a career building course and content. So in this video, I'm showing you 3 points on the screen. You are seeing it and you are watching it. So the point 1 is start to win, not to try. For example, if you are starting a painting, for example, I'm just telling you an example. If you are starting a painting a picture, and if you want to just try, if you want to make some try, it will give one kind of result. And if you want to make some beautiful paint, it will give some different result. For example, if you want to drive a car, if you just want to try to drive a car, it will give a one type of result. And if you want to drive a car in a perfect moment, it will give another kind of result. So whenever you are taking any trades, your mind should always strive for the winning. Okay, not just to try. Let's see whether it win or not. This kind of mindset you need to avoid. You need to have a mindset like this trade. Whenever you are taking a trade, you need to have a mindset like this trade must win. This trade must win. So this is the winning. This is the first point in whatever kind of business, not only this trading, in whatever kind of business you take. So number 2 is take responsibility of everything. So for example, if you take not only binary options and forex, take some business, take some hotel business, or take some a e-commerce business, whatever it may be. Every business has some losses and profits. The business means the mixing of profits and losses. So what you need to keep in your mind is you need to take responsibility of everything. Everything means what? You need to take responsibility of profits and losses. So whenever you make some money, you need to take responsibility of that. How? That because of you made some profits, and if you made some losses, because of you, the same you made some losses. So whatever it may be happens. For example, you made profits, you need to take responsible of that. If you made some losses, you need to take responsible of that. If you take responsible of both the loss and profit, the journey, your career your career comes in control under you. If you don't accept the loss, you cannot go further in the trading. Not only trading, in any kind of business, you are not suitable for that business, because that is not the reality. In reality, every business is a mixing of profit and losses. So simply you need to take the responsible. For example, you made some 10 winning trades today, you made some $1,000 today, and that is, take it responsible. Don't get over excited with that, and just take it as a responsible, and write down what you've done to make those trades, and remember everything, practice everything. For example, another day you lost $300, so write down in a notes that you lost $300, why you lost that, how you traded, and when you traded, and why you traded, and everything. Write down everything and take it as a responsible. So if you take that responsible of everything, you will become unstoppable. And number 3 is never cross your rules. So for example, in price action, in strategies, in money management techniques, whatever it may be, you will fix some rules. For example, in a price action technique, you will draw some lines, and whenever market cross that line, you don't take the trades. For example, this is an example. Whenever market cross some line, you will don't take the trade. So you need to fix into that rule. If you break the rule, the market will break you. Simple. That is very simple. If you break the rule, market will break you badly, very badly. So in also many management plans, if you fix some rules, we will discuss about the money management in the next further sections of the videos. So if you fix rules, never cause your rules. So these 3 bullet points you need to keep in mind so that you can become a successful trader in a very less amount of time. Welcome to Binary Options Secret Trading Course. This course is powered by Stock Tippers and the name of the course is Binary Secrets. And here in this course you are going to explore a totally different kind of strategies and concepts about the binary options trading. So you can make a lot of winning trades and you can make a very high profitable winning trades, and you can become a professional binary options trader at the end. Okay, so a lot of people are making millions of money in this field. Why and how they are making millions and why you are losing every time? On one hand, people are making millions. On other hand, you are losing every time. So what is happening here? There is simple one thing is happening between this is you have no knowledge about the binary options or trading. For example, not only binary options, in any kind of business. For example, you want to start a business, for example, any kind of business, and if you don't know about that particular business, and if you start with some investment, you will end up losing all your money because it will become a disaster for you because you don't know how to manage it. You don't know what happens next. So if you don't know how to drive a car and just jump into a car, and if you take the steering or wheel, it will become a disaster for you. So what you need to do here is you need to learn it first. If you learn it and practice it, you will become the master of that particular category, not only binary options. So first of all, you need to do it is you need to be very careful and responsible of this. You need to take this carefully and learn everything, make notes of everything, practice everything, and you will definitely become master of binary options and no one can beat you. You can make absolutely amazing trades and amazing profits. So what is binary options? I would like to tell you with a simple example. So what is binary options? Binary options is nothing but a forex. Do you know what forex is? Forex is a foreign currency exchange. If you import or export a goods, or if you buy something online from another country, or if you travel to another country, you need to exchange your currency to another currency, right? So to exchange two currencies, you need a broker, you need a platform, or you need a mediator. So this mediator is called forex. There are a lot of forex centers available here and there. You think like this, but it is not like a stock market. For example, in India, the Indian stock markets are available at, they have physical locations like NSE, BSE, Sensex, Nifty in Bombay and Delhi. And if you take America, if you take London, there are a lot of things like Wall Street, everything. So they have the centers, okay? They have the centers. But Forex has no physical center. It runs online in the name of ECN. ECN means Electronic Communication Network. Forex runs through ECN. So it has no any physical location. It runs online 365 days and 24 hours a day. But it has weekends, but it can also be run on weekends also. So here what I'm going to say is forex is just an exchange of currencies, and if you exchange a currency, if there is a exchange between two currencies, it will be it can generate a graph. Like for example, if you have USD INR, this is a pair, okay? For 1 USD you will get around 75 INR, okay? This is Indian rupees and this is US dollars. If you pay 1 US dollar, you will get 75 INR. So here you can see, this is, for example, I'm taking a January, okay? It's a January, it's a February, it's a March, sorry, a spelling mistake, April, May, okay, take up to this, and here is a price value. It's a 70 and 75 and 780, like this, okay? 85 and 90 and 95, something like this, okay? So just look at this. At January, the pair value is 85 rupees. This is just an example, okay? Just take it as example. At January, the price was 85 rupees, okay? So the graph stopped here. Again, at February, the price dropped to 75 rupees. And on March, the price reached the peak of 95 rupees. And on April, it dropped again to 80. And May, it dropped again to, reached again to 90. So you can see at particular time, what is the price of a value? Okay, what is the price of that particular currency? At what particular time, what is the value of that? This will generate a graph. So this is the forex graph. We are looking on binary options like IQ option, Binomo, all-in trade. You are seeing this kind of graphs, like, right? So this is called the rate of the value of the currency at particular time. So we trade on this kind of chart, whether we just predict. Simply, it is not a prediction, but this is a pure analysis. We will get information what we are going to do, okay? We are not just assume by closing the eyes. We will do the work and we will do trades, okay? So this is the forex. And what is binary? Binary is the byproduct of the forex, okay? Binary is the byproduct of the forex. It is also same like forex. It has the same pairs like forex. Everything is same, but there are some difference between forex and binary. For example, if you trade forex, I will tell you some examples here. If you trade forex, if you buy here, for example, if you buy here and market goes up like this, you can sell here, or you can sell here, you can sell here, you can sell here, wherever you want. Or market don't go up and market reverse back, okay? You can also sell here also. So wherever you want, you can sell, wherever you want, you can buy. So the time of exit and entry of the trades are in your hands. But in binary, you don't have the availability of time. For example, binary is the time bound, okay? You need to fix the time before you enter the trade. For example, if you enter the trade here in binary options, if you buy the trade here in binary options, and you need to select that the time frame, the expiration time, when you are going to exit. For example, if you select a 5 minutes, after 5 minutes your trade will close automatically, okay? Even if you win or not, you are going to exit the trade, okay? That is binary options. And for example, you bought here and the trade went up to here, you made a 10% profit, and trade up to here, you made a 20% profit. Trade went up to this here and you made 30% profit. The more it goes that in the direction that you predicted, the more amount you will gain in forex. But in binary, it's not like that. Whenever you enter, before you entering the trade, they will show you the percentage of something like 80% returns, something like this is a predetermined. So if you invest a $100 or 100 rupees, something like that, you are going to get $80 profit if you win. Okay, if you win, you are going to $80, and total amount is going to get back is 180 rupees, $180. Okay, this is a prefixed. Before you entering the trade, it is a prefixed. Okay, this is the difference between binary and forex, and there are a lot of advantages and disadvantages about the binary and forex, but we are not going to discuss all those nonsense. This is nonsense, really nonsense, because you came here not to know about these differences and theories and something like that. You came here to learn the strategy. You came here to make money. You came here to explore some different kind of secrets in binary options trading to make profits and winning trades. So I'm not lagging this to more. If I would like to explain you more about the forex and binary, the video will get long of length, and you will get really bored, and I don't want to make you so much of bored, because I want to tell you the secrets of binary options. That's it. So this is just a basic understanding of forex and binary, what is here and what is happening. So if you know at least this basic, that is enough. You don't need to learn more things, more concepts and basic theories of these things. So these are the basic template like this. You need to understand this. That's it. This is enough for you, and you need to remember one thing is this can give you really a freedom lifestyle. Why this can give you a freedom lifestyle and how? Because you can start with small amount of money. In forex you have to start with big money, but in binary options you can start with very small amount of money. And also forex has Monday to Friday timing, but in binary options you can trade 24/7 and 365 days. Even on weekends the markets are run in the name of OTC. Okay, so you can trade 365 days and you can trade anywhere from the world. So, and the registration is very easy. Sign upping into the binary option account is very easy than forex. So it can really give you the freedom lifestyle, the freedom of trading. You can trade from anywhere, you can trade anytime, you can start with very small amount. So this is a freedom lifestyle for your business. And we are not going to talk about any shit in this course. We directly jump into the main topics like candlesticks and price actions. So we are going to use some candlesticks secrets, candlesticks techniques and price action techniques to take trades in our strategies. And you need to remember that even the forex has $6.6 trillion liquidity per day. Even this field has that much of money. I'm not saying this is a rich quick scheme. You cannot become rich overnight. You need to spend so many days, and you need to practice it. You need to be sincere, and you need to work for it. So it takes a little time. You will grow your account and profile, everything step by step. It is not an overnight success. And the requirements you need to have is very simple. You need a computer or a smartphone. If you have both, that will be very good. And a stable internet connection and a comfortable chair to sit and trade. These three things you just need. So what does it cost? It does cost nothing for you, because to trade binary options you can open a demo account with demo credentials. You can start trading. You don't have to invest a single dollar into it if you cannot afford. You can start with nothing, but once you become a master in that trading, and if once you get confidence, then you can start with real money. But for first time, if you want to just start trading and if you want to just experience the trading, it doesn't cost anything for you. You can start with demo, and step by step you can jump into the real account. And 4 key points you need to remember for a successful trader, to become a successful trader: that you need to start to win and don't start to try. Why? Because if you just start to give it a try, your brain, your mind don't participate 100%. You always start to win and take ownership. What is the taking ownership? Because this is not a 100% winning formula. In any business, you cannot make 100% profits. If you say something like Elon Musk have the Tesla company, okay? If you see the Tesla chart, the chart goes like this: up and downs and up and downs and up and downs and up and downs. What is the up meaning? If there is a chart, if the market is going up, that means the market's value is increasing. If it is going down, the market value is decreasing. Even the Elon Musk have the losses. Okay, you understood what I'm saying? You need to remove this idea of winning from your mind. You have the losses and you have the wins, but you need to take the ownership of both and manage them. We will discuss in further videos how to manage your money, how to take ownership, even if you win or lose, how to make profits from that. And we will discuss you many things in the further videos too. And you need to look for success. Always look for the success. Don't lose hope anytime. If you step back, you cannot become a trader and balance the mind yourself. So balancing mind means sometimes if you win, you will get more excitement, and sometimes if you lose, you will get some frustrated. So both emotions can make you so much disaster. So you need to balance the mind. All these things will be explained in the further videos, okay? You need to watch every video step by step. If you skip any video and watch the videos randomly, you will never understand the things. You will miss many concepts in between the videos. So this is the introduction of this course on binary options trading field. I hope you understand everything, and let's start to the next video. In next video, I'm going to show you how to trade in a broker or in a platform. So let's get into it. So what is technical analysis? All our strategies depend upon technical analysis. So before moving further, let's understand what exactly it is. Technical analysis is the analysis of historical price movements in order to predict the future movements. Simply, it is the analysis of a method to predict the future market movements. This is a very effective method of analysis. In financial markets, price movements repeat themselves many times. This is because humans move price, and humans are hardwired and naturally inbuilt to follow patterns. The easiest way to understand this concept is to show you a little example to you. So you need to understand that one thing is there are some repeated patterns in the market to easily predict the future movements of the market. With this example, you can understand very easily. For example, in 1995, a cyclone occurred at some place in this world, and after 5 years, at 2000, at the same place, again a cyclone occurred, and after again 5 years at the same place, another cyclone occurred. So what do you understand here? By looking at this cyclonic pattern, you will guess that again after 5 years at the same place, there is a high chance of another cyclone. So this is the same thing we are going to use in technical analysis, just analyzing the historical patterns to predict the future movements. So let's move into the original topic, that what is exactly it looks like in market prices. You can see what here, it is a chart of USD/CAD daily chart image. Whenever the market touches this line, it comes back. Whenever it comes and touches this line again, when it's coming back, so again it touches this line and it's coming back. So what you understanding here, whenever the market touching this area, what area, this is the price line of 1.0625 something, and whenever market touching this line, it is coming back. It is not staying there, it is coming back. It is also called as reversal. Market is reversing back. Let me show you some whiteboard notes. That so here is a price point, okay, and market is going up, touching here and coming back. Again market went a little bit down and straight up with little up and downs, and market again touching the same point from that point, and it's coming back to down, and again market slightly went to that same point and coming down. So what you understand here in this chart, here the market touches the same price line 3 times in a row. Whenever it touching, it is coming back. So this, let me show you, this price line is acting as a key level or a reversing area of the market. So by seeing or by analyzing these repeating patterns, you are considering that this is the selling area. This is the selling area. Let me show you. Okay, you are considering this is the selling area or put option area. This is the sell area. So you are waiting for another price moment that it touches and it goes down. You are waiting for this moment again. So like you and me, there are thousands, more than millions of traders are following the same price action patterns, and they are also waiting for this same price level. Whenever market touches this line, and thousands and millions of traders also go for the put option from here. Whenever a lot of people trade at the same time and same place in the same direction, market automatically comes down. So here what you understand, the same thing. Here the market is touching and coming down 2 times in a row, number 1 and number 2 times in a row. So you are considering, you are predicting that at the same price line, if market touches this line 3rd time, also market comes down. This is what is exactly technical analysis means. So let's understand one more thing, that it is not a price movement moving up and down for a trader. A trader should be able to look through it and analyze things for doing good trades. We will be seeing a lot of points of technical analysis in this course, like candlestick psychology and many more things like support and resistance and trend lines and reversing patterns, candlestick patterns, and which will help us to take high probability confirmed trades. What we understand here is trading without technical analysis is nothing but gambling. We are not gamblers, we are traders. Hence we need to understand and learn technical analysis, and I will try to make it very simple for your understanding. In this course, you are going to learn a lot of technical analysis tips and tricks and many more. So that is in next section videos. There will be a lot of points about this. You will get familiar with it very slowly, step by step, and with practice, you will definitely get expert of technical analysis. So alright, let's move to the next video. I've seen many traders who get excited at beginning, and if they win couple of trades and start investing like mad and end up blowing their accounts with zero balance in no time. So there are many such people, and honestly it is very common to happen because we all are humans and we get excited very fast with things, but definitely end up with big trouble. So everyone needs to design their own money management plan, because the emotions plays and impacts on our trading. So with strict money management we can control it, and following it strictly, the money management plan in binary options trading, it is very needed. You should not invest more than 5% on each trade. You should not invest more than 5% of your entire balance on per trade, and I recommend you to keep it 2% strictly. But as you practice it more, you can stretch it to 5%. But however, you should never exceed 5% of your total balance. I will show you a trading plan at the end of the course. After you start understanding how it works, and then following that plan would be easy for you to understand. So to become expert in binary options trading, you need to have a good money management plan. So in this video we are going to discuss some terminologies that we are going to use in future videos in entire journey. These are very important to remember, so take in notes and remember everything. Number one is call option. Call means if you are about to trade for up direction, that is call. Call. C-A-L-L, call. So we also refer it as buy option or higher option, also called as call option. We only use call and put like this. So number two is put. Put is also called as down direction. When you are about to trade for down direction, that is called as put option, also called as sell and lower. And number three, ITM. If your trade is win and made profit to you, that is called ITM. Its abbreviation is, it stands for in the money. ITM means in the money. And OTM, number four, OTM is out of the money or off the money. If you lost the trade or the trade went against your prediction, that gives you losses. So that is called OTM, out of the money or off the money. And number five is ATM, that is called at the money. That means no loss and no win. How it forms, like I will show you. Here is the entry point that you enter. You enter here for up direction. Market went up and downs and up and downs and up and downs like this for 5 minutes, and market exactly closed where you entered. Here you entered at the same price and it closed at the same price. It is no win and no loss. It neither went up nor went down. So it is no loss and no gain. So it is also called at the money. Simply we call as ATM. And these are the five main terms you need to remember. And the other terms that you need to remember is, whenever we say OTC are the weekend market. Weekend, when the market only runs for Monday to Friday. But in some brokers and binary options, there is availability to trade on weekends also. So in weekends, the market runs in the name of OTC. OTC means over the counter. And whenever we refer TM, it refers, it means that time frame. And these are the two other meanings you need to remember. Bullish, whenever we say bullish, it is called up movement. Whenever we say bearish, it is called down movement. It is up movement and it is down movement. So these are the main terms you need to understand and you need to remember. Take a notes and write down everything, and let's move to the next videos. So in this video we are going to learn about candlesticks formation, how a candlestick form, and what is the market's chart. To easily understand, I'm just giving you some examples here. Here I drawn some image graphical thing for you to understand about the market's chart. Here it's a 6 a.m., 7 a.m., 8 a.m. some times are given here. This is a timeline. And here 100, 200, 300, 400, this is a value or price. This is a timeline, this is a value line. So I'm giving some example. At 6 a.m. market's value is around 900, okay? And at 7 a.m. market price dropped down to 300. And again at 8 a.m. market's price went to 700. And similarly at 9 a.m. market's price went to 400, and 10 a.m. to 900, and 11 a.m. to 600, and 12 a.m. to 1000, and 1 p.m. to 800. So this is how markets form their chart. A market's chart is nothing but a time and price values. At a certain time period, what is the value of market? For example, at 10 a.m., what is the value of market? The value of market at 10 a.m. is 900. So this is called a market's chart. At 11 a.m., the market's value is different. At 12 a.m., market's value is different. So here's in live example, you are getting the exact same values. At 11, here you can see at 11 o'clock, the market's price is 1.18500, and my market price went to down, and at 11:30, the market's price is 1.18475. So here it is happening. It's how the market is happening. This is the graph, and if you zoom in, you get the fraction of times. Like we take an example of hourly chart, like 6 a.m., 7 a.m. If you zoom in the chart, there are fraction of time frames like seconds, minutes, 5 minutes, 10 minutes, hours, multiple hours, days, weeks, months, years, something like that. For example, if I zoom out to the maximum, you can see that this is the April's market price is 1.19527, and this is the May. You can see here it's written as May market price is 1.22537. So there are a lot of fractions in this time. Here you understood how the market's chart will form. Now this is called a line chart. Generally, a line chart never gives you much information about the market. You can use some advanced price action techniques and strategies to trade with price line chart, but in binary options it is not useful for you. In binary options, we are going to use some other different kinds of graphical tools. That is, one of the best graphical tools is candlesticks chart. This is the candlestick chart, how it looks like. So it is also a graphical tool to show you the market's data. Market is moving up and down, only two directions, either up or down. So candlesticks chart show you the market's data within the time bound. For example, this is 6 to 1 p.m. 1, 2, 3, 4, 5, 6, 7 hours, totally 7 hours. So you can, here you are seeing a 7 hours of market data separately, in a wide range. If you want to include all the 7 hours data in a single box and watch what is happening, you can use the candlesticks. I will show you live examples in the live chart. Okay, so let's jump into it. For example, so here if you see in live market chart, it is a Euro USD pair. So I'm going to show you some chart details here on live. So I'm zooming in. For example, this is the real-time market, and let me show you something. For example, take this 9 a.m. I will draw some lines here to understand it, to make you understand. Here at 9 o'clock market is here exactly. I'm taking a time period, a range of time. For example, let me show you something. It's a 10 o'clock. Okay, so you can see I drawn in two lines. It is the 9 a.m. The first line is 9 o'clock and second line is 10 o'clock. Okay, this is a time period of 1 hour market from 9 o'clock to 10 o'clock. It's a 1 hour market data. So I'm showing you some other different things here. Market opened exactly at this level. Okay, and market closed exactly at this level. You understood? Okay, so market open, I'm just changing the colors to make you understand easier. So this is the closing point and this is the entering point. Okay, and I'm taking one more line here. This is the thing. This is the, you can see, I will show you. Market opened exactly here and exactly closed here in a 1 hour time. 9 a.m. market started at 1.18350 and closed at 1.8367. So it is a bullish candle. Why it is bullish? Because it opened here and closed here, little bit up. And you can see this is the lowest point of the market. This is the market's lowest point, and this is the highest point of the market. You can see clearly and observe it carefully, you will understand everything. So you can see these two white big lines are, this is the lowest point and this is the highest point of the market. You got it? And this is the opening of the market and this is the close of the market. You understood? So what is happening here? Market started here and went up to this white big line and came back to down and down and down and up to this white big line and went up and closed here. This is what happened. This is a 1 hour graph. And the same thing you can see in candlesticks. I'm going to open the same chart with the candlesticks. Okay, so here we already drawn some lines here. I'm going to use, this is a 1 hour period of time, so I'm going to use a 1 hour of candle. This is the candlesticks and I'm going to select here 1 hour. Why this 1 hour? Because this is the, now it is a 5 seconds. You can see every 5 seconds a new candle opens. You can see a new candle will open every 5 seconds. You can see here a new candle opened and another new candle will open now. And if you select 15 seconds, every new 5 seconds a new candle will open. If you select 1 minute, every 1 minute, every minute a new candle will open. So this is what it means. Here each candle has the lifespan of 1 minute. You understood? And if you select here the time frame of 15 minutes, that means here every candlestick has a time frame, has a lifespan of 15 minutes. Every 15 minutes a new candle will form. Here we are selecting one. If you select 1 month, for example, every month, every new month a new candle will start. You understood? And this candle will end at the end of this month and a new candle will start at the next new month date. So every candle has the time period of 30 days. You can see here. So for this example we are going to take a 1 hour time frame because this time period is 1 hour from 9 o'clock to 8 o'clock, 9 o'clock to 10 o'clock. Okay, so let's take this. Where is the 9 o'clock? Here already we taken some blue lines. Those lines automatically copied to this time frame also. So this is the 9 o'clock and this is the 10 o'clock. You can see these two blue lines here. This is the 9 o'clock. Market started here. I will show you in side by side view. You can easily understand. Okay, now we can easily understand that. So at 9 a.m. market started here exactly at 1.18350. You can see the candlestick started here 1.18350, exactly at the same point. Okay, and it went up a little bit up to this level. Okay, and market came down. You can see a long wick, a long shadow. Market went down up to this level, white level, and again came back and closed it at this level. This is what is happening in the candlestick. When market is opening, I will show you in whiteboard. You can see this. There are two types of candle. Mesa type of candles are two. You can see. I will show you something. This is a green color and this is a red color. This is a wick. Every candle, most of the candles have the wick. And in green color, this is a wick. This is a bullish candle. This is a bearish candle. Why this is a bullish candle? Because the market is going up. Why this is a bearish candle? Because market is going down. Sorry, market is going down. Okay, so whenever market moves from down to up, the market's open price is here and market's closing price is here. You understood? Here market going from down to up. So this is the called opening price of candle. This is the open of the candle, and this is the close of candle. This is the close of candle. And in bearish candle, this is a bearish. This is the bullish candle. So okay, and this is a bearish candle. So it is moving downwards from up to down. So this is the opening price value and this is the closing price value of this candle, because this is a bearish candle. This is the opening and this is the closing. You understood? Here it is going up. This is the open and this is the close. Here it is going down. This is the open and this is the close. So the point is clear now. And there are one more. These are the major topics in the candlesticks chart. There are four major things. That is, number one is bullish candle and number two is bearish candle. And what is the body of the candle and what are the wicks of the candle? I will tell you in simple way. So you understood what are the bullish candle and what are the bearish candles here. And what is the body of candle? If you take any candle, either it is a bullish candle or bearish candle, whatever it may be. For example, a bullish candle. A bullish candle. This is an example. And this is the bullish candle, has the two ends. This is the closing price and this is the opening price. Okay, opening price. So the space between, the space between this space, the space between opening and closing area, this is called body of the candle. This is called the body. Okay, so you understood 3 points here. Number one is bullish candle. What is bullish candle? When markets moves from down to up, this is called bullish. And when market starts coming from up to down, that is called bearish candle. And what is the body of the candle? Means the space between the opening and closing area is called body of the candle. And what are the wicks? These are also called as shadows of the market or candle. We call it as wicks. I will explain you very clearly. Now let's take an example of bearish candle. Here we are going to learn about the wicks, how wicks forms. Okay, it is the bearish candle. Bearish candle always go in a direction of down, from up to down. If a market goes from up to down, then automatically this is the opening price and this is the closing price. Understood? Wicks gives the information of highs and lows. This is the market's highest level and this is the market's lowest level. You understood what is happening here? Let me explain you. So market opened here, okay, and went down up to here, and from here market went a little down up to this level, and from this level market went up and a little bit up and downs and up and downs and up and downs. Market went up to this high, up to this level, and it came back and it closed here. Okay, it's closed here. This is what is happening beside a candle, behind a candle. So this is the market's opening level. You can see this is the opening and this is the closing, and this is the highest point of the market and this is the lowest point of the market. Simply, wicks gives you the information of market's high and low. Market went to, I already told you about a lot of examples in the technical analysis subject. So when market went up and it is the rejection to back and went up and rejection to back and went up like this. So these are called highs and these are called lows of the market. When market reaches the top area, this is called high. When it reaches to lowest area, this is called low. Market's low and market's high. So this is called upper wick, either in bearish candle or bullish candle. Wicks are called when it is the upside of the candle. This is called upper wick. This is called lower wick. And this is the highest level. Which is the highest level? This is the highest level. And this is the lowest level. So if you take some live examples like 1 minute or something, we are going to discuss it. Let's take a 1 minute or 5 minutes market. Okay. So let's take some 5 minutes market. This is the 5 minutes market. Understood? Market start. If you move your cursor on the candle, here on the bottom left side, there will be information given by the platform. You can see the market's open price is 1.83715. At what is the time of opening here is something 12.5. You can see 12.5. Where is the 12.5? I'm going to draw a line. 12.5. This is 12.5. Okay, exactly 12.5, and market closes at 12.10. Okay, 12.10 is the first 5 minute market. Here market closed at 12.10. So this candle opened at 12.10. Okay, sorry. So take this candle as example. This is a strong candle, so you will get easily understood. The market opened at 12 o'clock. So take a 12 o'clock. So whenever I'm moving this cursor, exactly, you can see in that chart also cursor is moving. So here market is opened. Okay, you can see. I will take You can see I am just taking, this is the market's opening area. You can see this is the market's opening area, or I will draw some other explanation. You will clearly understand. I will draw a line. So here market open, okay, and here market closed, okay. Here market closed, okay, and this is the highest of the market. You can see market opened here and went up to this high and came back to down and closed here. This is what is happening exactly in the candlestick. Take another example of this. So take this example. Here market opened here. Market opened here. Let's see this. Market opened here at this level. Okay. And market closed at this level. Okay. And market went up to this level. This is the highest of the market. And market went up to the low level is here. You understood? Yes, market started here and went up to this level and came back to this level and closed it here. So this is the opening and closing of the levels, and this is the body of the candle, and this is the highest of the candle, this is the lowest of the candle. Why we are taking the highest and lowest as the marking? Because this is a time bound graphic. This is the 5 minutes, in a time frame of 5 minutes. Let me take you one more thing. This is the 5 minutes market. Okay, this is the 5 minutes market. In a time frame of 5 minutes, what is the market's highest point and what is the market's lowest point and what is the market's opening point and closing point? These all are information are including in single candlestick. So in a single candlestick, you are getting 4 information: that opening price, closing price, and highest point of the market and lowest point of the market, and market's movement. So market opened here and closed here. This means market went up. This produced a bullish candle. If markets closed below the opening price, for example, market opened here and closed here, so this is the down moment, so it is a bearish candle. Okay, it is a bearish candle. If market opened here and closed here, this is an up moment. This is the up moment, so it will be generated a bullish candle. So you understood? I will clear and explain you once more. So if market opens here and closes here, this is called a down moment, so it generates a bearish candle in the chart. If market opens here and closes here, this shows you a up movement of the market, so this will generate a bullish candle in the market. So this is how a bullish and bearish candle happening, and you already understood what are the wicks. So in it we selected here a 5 minutes of time frame, so we are talking about the 5 minutes time frame. If you take a 1 hour 30 minutes, the market's 1 hour data will be shown. So in a 5 minutes of market in Euro USD, you are getting a data of opening and closing price and highest and lowest price of a market in a single candlestick. So I'm showing where differentiate images on this. Here you can easily understood. Just remember taking notes and write down everything. It is a bullish candle. So here it is the opening price and this is the closing price. And this is called upper wick and this is called lower wick. And the tip of the upper wick is the highest price and tip of the lower wick is called lowest price. And in the middle, this is called body of the candle. And as same as this is bearish candle. In bearish candle, it is quite opposite of that. Like this is the opening price and this is the closing price. This is lower wick and upper wick, and tip of the upper wick is highest price and tip of the lower wick is lowest price. Same, everything is same like this, but only one thing is different between these things is the closing price. Here it is the opening price, here it is the opening price, here it is the closing price, else everything is same in both. So here what you understand about the candlestick, what you have learned. There are different time frame charts ranging from 1 tick, even 1 second, to monthly charts. Bullish candles form when the rate increases, and if you take a up position, you want to see bullish candles. If you take a call option or buy option, you want to see bullish candles. And bearish candles form when the rate decreases. If you take down position, you want to see bearish candles. And candles consist of a body which shows the amount of pips between. So what you have learned about the candlesticks? Take notes and write down everything as the key points. There are different time frame charts ranging from 1 tick to monthly charts. Even there are 1 second candlesticks are also available, but in this platform there is not available. So bullish candles form when the rate increases. If you take a call position or up position, you want to see bullish candles, and bearish candles form when the rate decreases. If you take a down position, you want to see bearish candles. And candles consist of a body which shows the amount of pips. Pips means points. We will need to know about the pips in a forex trading, but in binary options we don't need to know about the pips. Pips are just like a points. I already told you that there is a price values. I will show you. Here you can see, here it is written as 1.1. You can see the price value is increasing, 400, 404, 406, 7. As long as I move the cursor up, the price points are showing increasing. So these price values also called as pips. So the candles consist of a body which shows the amount of pips between the opening and closing price. And wicks shows the highest and lowest price reached during the candle's life. Candles open and close based on the time frame of the chart you are looking at. So a 4-hour, for example, if you take a 4-hour chart, 4-hour chart will have the candles that open every 4 hours. If you select a 1-minute chart, every 1 minute a new candle will open. So this is what you learned about the candlesticks. So let's move to the deeper understanding of the candlesticks in further videos. So in this video, we are going to learn about buying and selling pressure inside the candlesticks. Before going further, I'm going to tell you that every candlestick's born neutral. Here you can see a small line. It is a candlestick. You may be thinking, what the heck is that? Why is there a picture of just a line? Well, it's not just a line. It is a newborn baby candle. The cute little line up there is a neutral candle. It is not yet moved up or down. It has to move. It is not yet moved. So it is a newborn baby, a brand new candle. Candles are always born neutral. After birth, they can grow to become either bearish or bullish, or on rare occasions, neither. Traders don't know what a candle will become when it is born. They can speculate, but they can never truly know what a candle is until it dies or until it closes. So after a candle is born, the battle begins. The bulls and bears fight it outlets. The candle shows us who is winning. If the buyers are stronger, you will see the candles move up and form a bullish white color candle or green color candle. If the sellers become stronger, you will see the candle move down and form a bearish red candle. This is all very obvious sounding, but take a moment to think on it. Each of these candlesticks is an indicator as to who is winning the fight between bulls and bears. Don't you find that quite amazing? Yes. So let's jump into it. These are the bullish candles. You can see here. These are different kinds of bullish candles. A bullish candle is what traders call any candle that has a bullish body. The baby candle has grown up and died with a bullish body. If it has a strong bullish body, it is a strong bullish candle. If it has a small bullish body, it is a weak bullish candle. Simple, right? But think about it. The candle not only tells you the price, it tells you the bulls are winning and their power. These bullish candles tell us there are more buyers than sellers and the strength of one over the other. This is critical information in the forex market. If your system tells you to go for the put option but the candle is clearly bullish, it might be a good idea to hold off on the put option. Why would you go for put option when there are more buyers in the market? So, reading candlesticks pattern enables you to better access the price in any situation. So let's jump into the bearish candles. A bearish candle is any candle that has a bearish body. What does the bearish candle tell you? It tells you that there are more sellers in the market than there are buyers. It tells you the sellers are in control and their relative power. So here, a long or a call option may not be a great idea. And next point is the wicks. These plays a major role in the chart or in the candlesticks. Besides displaying a candle's highs and lows, these wicks not only give the information about the highs and lows of a market. As I already told you in previous video, wicks tells you the highest and lowest of the market. This wicks not only tells you the highest and lowest of the markets, this gives you a lot of markets pressure, buying or selling pressure. So here I am going to explain you clearly. Understand it and make a notes of it. Remember the battle between bulls and bears? Well, it's time to learn what it's all about in relation to wicks. So what is the relation of wicks with the bulls and bears? Let me tell you. If a strong bullish candle, let me tell you, this is a strong bullish candle suggests that, for example, here, it is a strong bullish candle. If a strong bullish candle suggests that the bulls are in control of the market, what does a bearish candle with a larger, this is a bearish candle, what does a bearish candle with a larger upwick and a small body suggest? What it suggests to you? I'm going to explain you clearly. Small lower wick, here you can see it is a lower wick. I'm going to draw for you. Here it's a lower wick, okay, a small lower wick and a small bearish body and a larger upwick. You got it? A small lower wick and a small bearish body and a larger upwick. This candle tells us that at some point in this candle's life, the bulls tried to push up the market. In this bearish candle's life, what happened? The bulls, it is a bearish candle, but bulls entered and tried to push the market up. That is what the longer upwick tells us. However, before the candle closed, even the bulls tried to push the market up. Before closing the candle, the price pushed it back to down before it closing. The bulls tried to push up to this level, but this candle, before it dies, it pushed it back to its original level, back to the level. This is represented by the bearish body. So, and you can see this candle tells us that at some point in the candle's life, the bulls tried to push the price up. That is what long upper wick tells us. However, before the candle closed, the bears took over and pushed the price back. So this is why a long wick appeared. This is represented by the bearish body. And in the same case, another candle, a larger lower wick with a small bullish body and a small upper wick. What does it mean? This candle tells us that at some point in this candle's life, the bears tried to push the price down. The bears tried to push the price down up this level. This is what the longer lower wick tells us. However, before the candle closed, the bulls took over the place and pushed the price back to its level, up. So these are just two of the very basic concepts of candle trading. In the next section, we will go over why this information is useful. Okay, just take notes of it and you will get a lot of information, and write down everything and remember everything. Practice it. So what you have learned, before going further videos, just recall what you have learned. Just recall what you have learned in this video. A bullish candle means, the point number one, the bullish candle means there is currently more buying pressure in the market. As long as buyers maintain enough buying pressure, the candles will be bullish. If the buying pressure eases or decreases and selling pressure increases, we will see the bullish candles become smaller. This represents a decrease in a bull's strength. And number two is bearish candle. This is currently more selling pressure in the market. As long as sellers maintain enough selling pressure, the candles will be bearish. If the selling pressure eases or decreases and buying pressure increases, we will see the bearish candles become smaller. This represents a decrease in the bear's strength. And the wicks. Wicks shows us the highs and lows, but in certain cases, reading them reveals a very useful information. We are going to learn them further, in deeper and deeper. In this video, we are going to learn about the basic candlestick patterns. You already know about, in previous videos we discussed about the patterns. Market always follows some patterns, the repeated patterns. By analyzing the repeating patterns, we are predicting the future movements. So same like the charts, candlesticks also have some patterns. We are going to learn about the basic patterns in this video. These are the very basic candles, also called as standard candlesticks. So for the first one is the Maruboju candlesticks. You are seeing here, these are two Maruboju candlesticks. You are observing one thing here. These candles have no wicks. A Maruboju candle has no wicks. So if it is a bullish Maruboju, this is a bullish Maruboju. It opens where it is open, that is the lowest point also. Where it closes, that is the highest point also. So if you see a bearish Maruboju, its open is the high. It is where it is open, it is the highest point. Where it closes, this is the lowest point. So there is no any wicks. Okay, it is a complete candle's body. A Maruboju is a strong continuation pattern. Continuation means if a market going upward direction, up and up and up, and these candles form, this means the market is ready to move in that same direction for some more time. So this is called continuation. A Maruboju is a strong continuation pattern that suggests bulls or bears are in total control of the market. When this kind of candles are appear, that means the market is in total control. In bullish Maruboju, that means the bulls are in total control. If bearish Maruboju comes, that means bears are in total control. A white or green bullish Maruboju suggests that this candle suggests that bulls are in total control. Think about it in terms of battle between bulls and bears. When the candle opened, the bears were not able to push price down to make a new low. The bulls pushed up consistently and closed it at the high. A red Maruboju suggests that bears are in total control. Once again, the battle started, but the bulls this time were not able to make a new high here. Instead, the bears pushed it down consistently with the bulls unable to hold their ground, so the candle closed at the lowest low. Maruboju candles are very strong indication of a continuation market pattern. Since the bulls or bears have so much power shown by the Maruboju, it can be expected to carry through the next candle. And now the next pattern, the basic pattern, is the spinning top. It looks like a spinning top. A spinning top indicates a big fight happening between bulls and bears. Both sides are giving it their all. Here, market, I'm just drawing something. Market try to push up to this level, and bears again push it back to down. And bears try to make a new low up to this, and bulls again push it back to down. So there is a big fight between bulls and bears in this kind of candles. So both are in same power. A spinning top indicates a big fight happening between bulls and bears. Both sides are giving it their all. Nobody has won the fight yet. So the candle closes near to its opening price. It is the opening price, this is the closing price. It closes near of the open. Okay, neither bulls nor bears, both are not winning. Okay, take a look at the spinning top below for a clear explanation. Here also what is happening, the bulls try to move the price up and bears try to back it down, and bears try to move it down, and bulls entered and push it back to up. So here is what I mean, a big fight is happening here. So let's understand a little bit. So a spinning top body's candle, a spinning top's body can be either bullish or bearish. The both are not as much as different. Both bullish spinning top or bearish spinning top indicates almost the same information, but that is not overly important. What is important is that there are two wicks on either end that are much larger than the body. Here you can see what a spinning top is. The wick in the both sides are very larger than the body. You can see the wicks are very larger than the body in both sides. This indicates a struggle between bulls and bears, but neither was able to claim a decisive victory. In a trend, a spinning top indicates indecision. So simply you need to understand that if any spinning top candlestick pattern appears in the market, that means market is not taking any decisions to moving up or down. It is not decided yet to moving up or down. So this is called an indecision candle. The spinning top is also called as indecision candle. So here you can see the bulls tried to push up the price, but they didn't manage to hold the significant high. So this is a spike, and here also same. So market not decided the direction yet. Here you can see it is a bearish reversal market. Why it is a bearish reversal? Because market is moving from down to up here, and from here it is reversing back, right? So this is a bearish reversal. It is a bearish trend, and from here market started moving up. So this is called a bullish reversal. You understood? This is called a bullish reversal. This is a bearish reversal. If a spinning top appears, this is a spinning top. This is also called here some mistake in this image. Here that's the wick, low wick also need to be very long. Okay, here if a spinning top appears during a bullish trend, it indicates to us that bears could be taking back control and potentially end up the trend. This means this is also comes like same kind of candlestick pattern. This is also a spinning top candles, similar candle. So what it means is when this kind of candle appears in the market, that means the bull trend is, there is a chance to end the trend. The bull's trend is going to end here. So this is what it indicates. Spinning top are also known as reversal candles, and the term reversal candle is a bit of misnomer. A spinning top candle does not indicate a definite reversal, it shows a possibility of reversal. So what it means is when a candle's appeared, it doesn't mean that market definitely goes up. That means there is a high chance of market reversing, but it's not a confirmed trade, but there is a chance, a high chance. The color of the body is not extremely important with the spinning top. Either it is a green color or a red color. The color of the body is not so important in the spinning top candlestick pattern. It can suggest which side has slightly more power though. If it has a green body, then the bulls are slightly stronger. So I hope you understand what I'm saying here is, in spinning top candles, the color of the candles is not so important because the both are giving the same information, but these colors can give you a little more information, a bit of information. Like for example, here the bulls and bears are fighting between each other with same power, and market is not taking any decisions to go up and down. But here you can see a small green candle, so you can assume, you can consider that bulls are little powerful than bears in this fight. So if this kind of candles appear, you can consider that bears are little more powerful than bulls in this fight. So this is what it means. And next basic candlestick pattern that you need to understand is a doji. A doji means it has no body. Similar candlestick, like at first we discussed about the Maruboji candlestick, which has no wicks but a full of body like this. In doji, it has no body but with wicks. It starts here and goes up and comes back and goes down, comes back and closes at the same point. You are understanding? It is not making any movement in the market. Where it started, it is closing at the same point with no body of the candle. That is called doji. In the market, doji has the very medium strength because market has no any volume of buyers or sellers. So we maximum avoid the dojis. Whenever we see any doji type of candlesticks, we mostly avoid the trading. Dojis come in different shapes and sizes, but they are all characterized by having no body. This means price closed at the same place the price opened. Most traders subscribe to the close enough is good enough. So a doji is also a form of indecision, and it is similar to a spinning top. This doji is also similar to the spinning top candlesticks. Whenever you see a doji on your chart, you know there is a strong fight going between the bulls and bears. Yes, whenever a doji appears, there is a strong fight between bulls and bears in a same power. So market is not taking any decisions. It is not understanding whether to go up or down. So no side outright wins the fight, so it closes at the open or at least very near it. You can see from the image above, the doji tells us very similar story as spinning top. In fact, pretty much all indecision candles tell you a similar story. We will go into a greater deal in the next section. So what you understand here is doji has the medium strength or low strength. We are not going to take any trades with the doji candlesticks in binary options. So just revise what you have learned in this video. Is number one is Maruboji candlesticks that has no wicks but full of body and which has strong market control, and it is a spinning top which has a big fight between bulls and bears with little body, and it is a reversal pattern happening in a market. And this is the doji has the no body with complete full of wicks, so it is also called as indecision candle. We are not going to take any trades with this doji. You are going to learn many more candle patterns that has very powerful impact on the market and to take trades in the further videos. So let's jump into it. So reversal candlesticks. All reversal candlestick patterns are the same. Whenever any of them form in a trend, they all mean the same thing. A transition of power has occurred. This is not the easiest concept to understand. I will explain it here. So make notes of everything and you can revise it anytime you want again. So reading candles is all about thinking how the candles you see are a deception of the fight between bulls and bears. In the first section on candles, you will learn of the difference between bullish and bearish candle. Now it's time we go a little deeper into what bullish or bearish candle means in relation to the battle. So I'm showing you a little image. This is a fight between bulls and bears. This is a bearish candle. It forms when the bears have more power than the bulls. When the bears have the power, you will see bearish candlestick patterns. If the bears have more power for a long period of time, you will see a bearish trend. This is a bearish trend. If bulls have a very little power and the market is controlled by the bears, you will see a bearish trend. All candles look like a bearish. So now imagine a spinning top pattern forms in the trend. You can see here the bear's power is 9 and the bull's power is 1, because you are not seeing any bull's candle here. You are seeing everything is bear candle. So it is called as bearish trend. Okay, so and the next thing, imagine a spinning top pattern forms in the trend. In that trend, in which trend? In a bear's trend. That would indicate that the pair has reached a moment of indecision. From here to this, the market is going in a bearish trend. And suddenly this kind of spinning top candlestick pattern appear. This means market is not in decision. Okay, this is a very clear indecision pattern. The sliders on the side have numbers from 0 to 10. You can see here there are two scales. It is a bullish scale and this is a bearish scale from 0 to 10. When the bulls are at 10, when the bulls are at 10, if this bull is at 10, it means they have a lot of power. At 0, it means they have no power. You can see the bears at 1, so it has less power. It same goes for the bears. If the bears are at top 9, 10, it has more power. If it is at low scale, that means it has low power. So what happens when they are closely matched in terms of power? Here you can see bears are in 5 and bulls are in 5. Both are in same. They are very closely matched in terms of power. That's right. An indecision candlesticks form. So whenever an indecision candlestick formed, you need to remember, you need to rearrange the patterns, that you need to remember that the bears and bulls are at the same power and market is in indecision situation. You need to remember this. So when the bulls and bears have equal amounts of power, you will get indecision. Indecision. As soon as one side gains power, the candle will reflect it. When these candles appear, that means both are in same power, and slowly the market moves up or market moves down. Either happens. So after this, if any candlestick forms, that means market is going in that direction. Memorizing a bunch of different patterns is not as useful as understanding what reversal pattern actually means. So just you need to understand what is a reversal pattern. Whenever market is reversing, you need to understand what is happening in the market. So that's why I'm showing you some images here to make you easily understand. Whenever this kind of reversal happens, that means market is trying to change their present trends. So this is what you need to understand about the reversal patterns or reversal charting system. So whenever in the future, if I say reversal pattern or reversal market situation, you need to understand one thing, that market is about to change its direction with the power of the bulls or bears. So let's jump into the next videos. We came to the main game in this course. We came to the section of price action, the real game. What is price action trading? All price movement in binary options trading comes from bulls and bears. Bulls are also called as buyers and bears are also called as sellers. For example, take an example here. If the price is moving up, it's because there are more bulls than bears. And if the price is moving down, that means it is because there are more bears than bulls. So the binary options market, or any other market for that matter, is in a constant state of struggle between bulls and bears. Price action trading is about analyzing who currently controls the price, bulls or bears, and if they are likely to stay in control or not. If you are analyzing something and if your analysis shows that bulls are in control and they are likely to stay in control, then you can go for call option. And it shows that bears are in control and they are likely to stay in control, then you can go for sell option or put option. So how do you analyze who is in control of price? By using simple price action techniques. Here, this price action strategy works in all market conditions, but we have some restrictions and instructions. We will give it in next section of video, that way not to trade. So take notes of everything and carefully understand each and every topic that is very important for your successful trading journey. So most of the traders use some third-party indicators or softwares to generate signals. But what I'm about to say is indicator-based strategies work well in specific market conditions. If you have a strategy that works in low volatility markets, it will fail in high volatility, ranging or trending market conditions. But price action adapts, indicators don't. Price action doesn't only adapt to changing market conditions though, it adapts to different pairs, different time frames, and crucially to different traders. And I would like to tell you one important thing here. So we are going to use two major things in this price action. Number one is key levels, and number two is candlestick analysis, advanced candlestick analysis, and there are no confusing techniques and there is no stress. It is very simple to follow. And I would like to ask you something. This strategy was created with simplicity in mind. The most common downfall of today's traders is overcomplicating their strategy. We have all seen charts like this. You can see here a chart. Are you seeing it? Yes. How can you trade comfortably using a chart like this? How can you trade efficiently using a chart like this? How can you trade from your smartphone using a chart like this? You can't trade using this kind of charts. It is too messy. The core rule of my price action strategy is to keep trading simple, because the forex trading strategies that work best are always simple. The only thing I place on my charts is some lines, some key levels, some drawing, and conjunction with candlestick areas analysis to trade binary options. So what does a clean forex or binary options chart look like? Like this. It is a much better than previous, right? Not previous, most of the other charts. Look at this chart. It is very simple and very clean. This chart is uncluttered, easy to understand, to navigate, with nothing to distract you from analyzing the price action. This style of trading is quick, efficient, stress-free, and you can do it from anywhere, including your smartphone. So let's jump into the strategies and understanding the theory. I'm going to explain you every theory first, then after we are going to discuss about the strategy. So keep watching every video step by step. And we entered into the main first topic in the price action, that is trend analysis. How we can analyze a trend of the market. There are two things in any kind of market, that is uptrend, also called as bullish trend, and downtrend, also called as bearish trend. And if there is no trend, no uptrend and no downtrend, that is called no trend, also called as sideways market. So let's jump into it. The first topic is uptrend, the bullish trend. So here you can see the market. The market will look like this kind of thing. Market goes up and down, up and down, up and down and up, and finally if you look at in whole figure, the market is moving upward direction. How it is forming? Let's discuss something about here. Market, if you see this kind of market, you say it is an uptrend. If you see this kind of market, you see it is downtrend. But essentially, and if you take it into a deeper look, the market can never go in a straight up way. It makes a lot of up and downs and up and downs and up and downs, and makes a high, makes a uptrend, makes a trend of up direction. Inside this, it makes a lot of up and downs and up and downs and up and downs like this. So overall, if you see, it is a trend of up direction, but it has also made many downs also. So let's discuss about this. This is a market going up like this. We called it as high and we called it as low. We already discussed about this high and low. This is the high. We are discussing about an uptrend market here. Uptrend market. So it is a low, it is a high, and market came back to down and went back again. So you don't take it as a high, you take it as a higher high. Why? Because this high is greater than this high, previous high, and you don't take this as a low because this low is greater than the previous low. So this is called as higher low, this is called higher high, and when it come down and go back again, this is called higher low, and this is called higher high. In uptrend markets, every swing makes a higher than the previous. So let's take to the chart. Here also given the same thing, we can see clearly here. This is a high, and this low is higher than this low, because that's why it is called as higher low. You can see this is higher than this, and this is higher than this, and this is higher than this. Also this high is higher than this, high is higher than this, high is higher than this. So that's why, that is the reason we call it as higher highs and higher lows. Here I given a 2 points for you that you need to remember, that in an uptrend market, every high is higher than the previous high. So every high is higher than the previous high, and every low is also higher than the previous low. Every low is also higher than the previous lows. So even it is highs or lows,
both are higher than the previous ones. Okay, so let's take some live chart examples and go to the live market now. So here, take some chart, whatever it may be, any kind of chart, and let's find a uptrend here. Let's find out a uptrend market, a clear and clean uptrend market. We're going to find out an uptrend market. Here you can see market went up from here and made it down, and went up from here and made a small down, made up from here, made down, as up from here and small down. So you can see this is a high, this high is greater than previous high, this high is a previous than previous high, this is a also higher high, and here you can see the lower low. It is a higher low, it's a low and it's a higher low, and this low is higher than the previous low. This is also same kind of thing. So overall it's making an uptrend. You can see the market is moving upward direction. So this is an uptrend. You can find out this kind of trends in many situations, in many times. So find out this kind of trades in previous market. Just look back into the chart and find some more like this. Here you can see this is also an uptrend. You can see market made from here up and little down, sorry, it's up and little down and up, a little down and up, a little down. Okay, so this is called uptrend. And if you move to the downtrend or bearish trend, it is quite opposite to the uptrend. So as we explained about this is also same kind of thing. Market goes down and made a little up, goes down, made a little up, goes down, make a little up like this. So this is high, this is low, right? So this is a high, but this high is lower than the previous, so it is called as lower high. And this is lower low, this is lower low, lower low. Why? Because lower low, because this low is lower than the previous low. That's why it is called as lower low. And this is lower high, because this high also is lower than the previous high, lower high. So here what we explained exactly same thing. It's a high, it's low, and it's lower high, lower high, lower high, and it's lower low, lower low, lower low. Here I given it 2 points. You need to read this. Every low is lower than the previous low, and every high is also lower than the previous high. So either it is high or low, whatever it may be, both are lower than the previous ones. Okay, you need to remember this. And let's take some real-time price examples. So we need to find some downtrends here, right? This kind of thing. You can see it is a clear and clean downtrend. Market is going down and up a little bit, and down and up a little bit, and down, up and a little bit, down and up a little bit, down. And here I will tell you some more example. Here you can see exactly same thing what happened in the uptrend. It is quietly opposite, and what we explained here, it is exactly you are seeing on the real time chart, right? It is exactly looking like same thing. So this is called downtrend. It is making a trend in a downward direction. And I would like to tell something more after this section. So this is a no trend. Market makes highs and lows, highs and lows, highs and lows. If you draw a line, almost the highs and lows are in same areas. There is no higher highs and lower lows. You can see almost at the same areas. Let's find something like that in the real chart. So you can see here, if you draw a line, you can see here market went up and made it down, went up almost here and down, and went up, down and went up. And you can see this is a ranging market box. You can see this is also called as ranging, you know, sideways is also called as ranging market. So this kind of charts are also called as sideways market. You can see almost you can see here it is another you can see this is called ranging markets. Almost the market's highs and lows are at almost at the same areas. Let's take some drawing here. You can see market went up and down and up and down and up and down and up and coming back down, and it's a ranging area. This market is ranging area, so also called as sideways area. Don't get confused, okay? So if there is no trend, if you are not finding any uptrend or downtrend, it is simply called as a ranging market or sideways market. I'm going to tell you one more thing here. Let's take this whiteboard. So for example, if market went like this is an uptrend, you already know this, and made like this, and at one point it made like this. So you can see here this is a lower higher low, higher low, higher low, and higher low, and market didn't made another higher low. You can see it broke in this level. You can see here market broke into down. This means the uptrend is broken down and it's changed its direction. So there is no more uptrend from here. It is going down now. So this is what you need to understand. So let's take example of downtrend. Market going like this. Sorry, like this, like this. At some point it makes like this. This previous high is broken here. You can see this line is broken here. So there is no more downtrend here. It is broken, and the trend is going to change from here at this point. This breaking point is called breakout. You understood? Here this is called breakout. A breakout trend. This is a trend breakout. It happens in any market conditions. Let's see some real-time examples. You can see here market went up and down, up and down, up and down, and up and down, and up and down. Here you can see the market breaking this line and making new trend here. You can see the market trend broken here, and market started going down from here. The uptrend is closed. It is changed the trend. So this is called a breakout. It happens also in downward direction, and it changes to upward. You can see many examples like that on real chart if you see it. And also in candlesticks there are breakouts and some rejections like that. We will discuss about it in next video. So now let's see how to draw a trend line. Because with this trend line we are going to take trades. So it is very simple. It is very simple to draw a trend line because it's a simple line. For example, just connect in an uptrend, just connect the lows of the trend and make a line. That is called a trend line. So make a downtrend a trend line. So here you can find in a graphical tools there is a trend line option here, and just connect from here to 2 points and you can find a trend line here. Okay, and you can see the market broke in this trend line. This is called a trend breakout. So from here market goes up. So here market, the candle broke in this level. So this is called a breakout. You understood? Let's take some other examples. You can see, let's take another trend line and draw here. So take a trend line and draw from here. You can see market went up and down and up and down. This is a trend line. It is an uptrend line, and here you can see market broken to down. The trend line is broken, so market goes down here. When the candles broken this trend line, market goes in opposite direction. That means the trend is changed. Okay, So let's take some other trend lines example, how to draw trend lines. Here, let's find some best examples in another pair. Let's take, kindly wait, and we will take some best examples. Okay. Here, the market making up and downs and up and downs and up and downs, and I'm making that. When market makes the up and downs 2 times, take a trend line. You understood? Take a trend line. So first time it made here, and second time it made here. So draw 2 low points and you will find a trend line here. So market is unable to break the trend here. You can see. So here you need to draw the trend line. You can draw trend line like this. Market went up and coming back and went up and touching back again and going up, and from this level market is broken down and market is going in opposite direction. You can see here. So whenever breakout happens, the market goes in reverse direction. So this is called a trend line theory in price action. And so same like this, in downtrend you need to draw a trend line like this. When market goes down and up, just mark these 2 points and you will find a trend line. Number 1, second touch, first touch, and a third touch, market goes and reflects here. The market goes down again from in this well. If goes again and touches this line, again goes back to down. This is called drawing trend line, and this is trend line theory. So I hope you guys understand about the trend lines clearly now. And now let's move into the support and resistance. How to draw support and resistance, and what are those, and what are the breakouts in the support and resistance, how to trade effectively with support and resistance. We are going to discuss about those things, everything clearly in next videos. So let's watch everything clearly. If you don't understand anything in this video, you can re-watch this video again to understand it easily. If you have any more doubts, you can mail to us. We will reply to everyone.
This is the second topic in the price action, that is support and resistance. Placing support and resistance areas is the most important skill you can master in trading. And placing or drawing the support and resistance is very easy. Support and resistance areas divide your chart up into 2 areas like buy and sell areas. An area that sits above the current price is a sell area, an area below current price is a buy area. Simply, I will explain you clearly. Simply, support means the buyer's area. The terms buyers and bulls are interchangeable. Support is a buy areas, or buyers are found at support. If you want to find some buyers, big buyers, you can find them at support area. And the resistance is a sell area. The terms sellers and buyers are interchangeable. Resistance is a sell area, as sellers are found at resistance. You can find more sellers at resistance areas. For example, we are taking a chart here. It is a GBP USD chart. You can see prices approaching the blue shaded area. Here you can see it's a blue shaded area near the price, and it is nearly 1.35000. This is a strong resistance area or seller's area. When price approaches a seller's area, large amount of sell orders in forex, large amount of sell orders are triggered, countering buy orders. So that usually results in price stalling or even turning around completely for a reversal. The price goes down from here. Why does this happen though? It is very simple. The market movers. I would like to tell you something about the market movers. Let's go to the whiteboard. So, who are the market movers? Okay, market movers are simply called as the big traders. Big traders have the large funds to trade. They have the larger funds. Who have the larger funds? Banks, our banks, central banks or local banks, whatever it may be. Banks and mutual funds or hedge funds, also called as. These are our personal, individual, big profile traders. They are or any these are called, I would like to tell you that these are called market movers. Why they are calling as market movers? Because of them market can move their direction, not only because of the import or export or exchange of the money, not because of these things. Because of these big players, market also can move in some directions. So what I'm saying here is, it is simple that market movers like banks and hedge funds place their orders at areas of support and resistance. Why do market movers place their orders at support and resistance? Good traders don't randomly place entry orders and hope that they get lucky. They place their entry orders at significant price levels. Significant price levels comes in many forms like yearly, monthly or weekly highs and lows, and rounded numbers. We will discuss about the round numbers in next videos. What are round numbers? Those are also called as psychological levels, and all-time highs or lows, and areas which price has stalled or reversed more than once. Here you can see the price reversed from this area more than one time, so this is considered as a support area. If it is a support area, market starts moving up, because here support area consists of buyers. So when market starts buying, market goes up. So in this above chart, it is also GBP USD chart. You can see two times green light highlighted. Next time market approaches this line, it goes up, it pulls back again to the up direction. So why? Because market movers place their buy orders at these areas. When price hits this area, the buys trigger, causing a reversal. So this happens all the time on every forex pair in any financial market for that matter. This is how markets work. Buy and sell orders are grouped together in the same general area, and when they are hit, we see the impact on price. So how to place support and resistance areas? There are a lot of indicators. You can see a lot of custom indicators that out there that claim to give you great support and resistance areas, but I have tried all of them, but I do not find them reliable. Though those are already tested and those are not reliable. Support and resistance placements still need to be done by an individual person. A good forex trading or binary options trading strategy requires some work. You need to work something. But don't worry, it is easy. All you are doing is placing horizontal lines when you spot an area with 2 or more bounces. I'm going to break it down into a step-by-step process for you though. But first, we need to define some rules for support and resistance areas. Let's check it out then. So placing support and resistance. How you can place the support and resistance? There are 3 key rules you need to keep in mind when placing support and resistance areas. Number 1. Place areas on the body of the candle. The body is more important than the wick. We already discussed about the body of the candle and the wick of the candle. So placing support and resistance on the body is important, not on the wick, because wick are not real thing. Number 2 is the more recent the bounce, the more important.
prioritize recent bounces over older bounces, because when the market is starting bouncing from, let me show you on the whiteboard. For example, market is making some bounces like this. This you found as a support area. So okay, this line is a support area line. So, and if you zoom out, for example, if you zoom out, a large number of market is going like this. If you take a 1 month of chart, there are a lot of support and resistance you will be found. So you will draw many support and lines like this on your chart. So you need to prefer the recent support and resistance areas, because the old support and resistance may not be working good. So you need to prioritize the recent ones. Okay, so this is what it means, the point number 2. So let's go to it. So here there are the more recent the bounce, the more important. Prioritize recent bounces over the old bounces. And number 3, you need at least 2 connecting bounces to place a support and resistance area. There are a few expectations that there are monthly highs and lower highs are very good, but that is not real. You can find a best support and resistance areas. You need to find just 2 bouncing areas and connect them as a line. Those will be called as support and resistance areas. And there are few steps I given here. You need to note down in your notes. So with these steps, you can easily draw the support and resistance. After this, we will go to the real market chart and we will draw some support and resistance lines. So number 1, select any time frame chart and zoom out until you see around maximum amount of data. And don't worry if you see little or more or less, it is not a big deal. Number step 2 is identify the highest and lowest bounces and place an area at each. Remember, place your areas at the bodies, not the wicks. And as these are highs and lows, placing them based on a single bounce is enough. And place support and resistance areas between the first 2 by connecting areas which have 2 or more bounces. So let's get into the charts, the real-time charts. Let's take some real-time market charts, whichever charts. For example, take the chart and zoom out into maximum. How much you can zoom out? Just zoom out and go to here a graphical tools and select the horizontal line. Here you're finding, I will draw something for you here. If you look at this chart, you will see something that at one place market is bouncing many times. We will show that. Just wait. Just look at this. Here I'm going to draw something here. Here you can see market came here and made an up direction and again came to the same level and made another direction. So here 2 points, I'm connecting something here. I'm going to connect some line here at this area. So this is a support area. You understood? This is a support area. How you can find this as a support area? Because it is a 2 points that connecting a reversal bouncing area. You can see this is a 2 points connecting the market price and bouncing from the same level. And here why market didn't bounce it back? Why? Because I already told you in a previous video, this is a breakout. This is a breakout. Before going to that, I would like to tell you something that I already explained you about this. What is that? That is breakouts. The market goes like this with support and resistance areas. Sometimes it breaks. So this is a resistance area. This is a support area. So whenever market touches and comes back, this means market goes back. But sometimes market breaks with strong push. That means this is a breakout. I already told you in the previous video about the breakout in a trend line class. So you can see this is a breakout, so market is going to change its direction. So this line is not going to act as a resistance anymore. So you can see the market broken out here in strong, with strong push down. It's broken. So here it's a bounce, here it's a bounce, here it's a bounce, and here is a breakout. And from now, here again market broken up. So in two areas market is breaking, not rejecting. You can see at the same level. Let's just assume this here, this same line acting as a resistance. This is a support line. For here it is a support line. Now you can see this same support line is acting as a resistance here at this point. Here at this level you can see market is touching that line and coming back. So let's take some of the examples that you can easily understand. Let's take some of the examples, okay? Let's take some best markets, like take GBP USD, so that you can find best areas. So here's 5 seconds. Then make it to 1. Make sure that time frame is in 1 minute, okay? I will take a whiteboard and I will show you how to draw the support and resistance line, so you can easily understand that. When market is going like this and jump from here, same levels. So this line works as a support. Why? Because from here market is going up, so buying area, okay? This is a support line, and at the same time market is breaking down. Let's take another thing. Market is coming down like this, and just connect a 1 and 2, just 2 bouncing areas, and connect a line, and you will find a resistance area. From this line there is a high probability market will touch and come back, okay? And you can see, I will show you some other things. Like sometimes market comes like this in a trend formation. So in a trend also you can draw the support and resistance like this in a certain angle. So this is a resistance, this is a resistance line, and this is a support line. So support and resistance can be drawn like this and like this also. You understood now how to draw the support and resistance line. Sometimes you can draw like this, connect 2 same reversing point and find the levels. Sometimes market goes like this, goes like this. So every time you draw something up and down bounces, connecting 2 bounces, a line, that is called a support and resistance line. So you understood how to draw the support and resistance line now. Now let's go to the real-time chart and make some lines. So this is market moving, this is the current market price. So draw a trend line, make a line from here. So this is the 2 connecting points. You can see, I will show you where is the 2 connecting points. This is the point, let me tell this. This is the point number 1, this is the point number 2, connecting 2 points. This is the point number 3, and draw another 2 connecting points from here. Sorry, draw another trend line like this. So you can see this is a support and resistance line. You can see the numbers, number 1, number 2, and whenever market touching this line, it is reversing back. You can see it is reversing back. You can see now it is touching. You can see I'm showing you now the market touched this line again, and it is a strong bullish area, but still it is not breaking up. It is still at the same area, so it is reversing back. You can see whenever the market touching this support or resistance level, it is reversing. Are you understanding here? Are you looking what is happening here? You can see market touched here, and market is rejecting. You can see market is starting going down with a weak market. So here is what is happening. Whenever the market touches the line, it shows an impact of the price reversal. This is how you need to draw the support and resistance line. In next video, we are going to discuss about how to draw the strong levels. Because all levels are not stronger. If you find the strong levels, you can make a very good trading opportunities. So, and also we are going to discuss about the candlestick analysis, because only with the candlestick analysis you can combine the candlestick analysis with the key levels to make perfect trades. So let's move to the next videos. So we learned how to draw support and resistance lines and trend lines, and we already learned about what are breakouts, and we learned about that. But sometimes market gives you some tricks. Let's find out what are those. For example, market went like this and came back, went like this, came back, and you drawn a resistance line here, okay? And market again touched here and showed a little rejection. You will start enter here, okay? You will start entering trade here, but market again goes back to up. Market don't come to back. Why this happens? Because if this happens, that means the resistance line you drawn is not strong level. This is a weak level. So the market can break this weak level easily. So here a breakout happened. You need to find a strong levels. So how you can draw the strong levels using some techniques? Let me show you those things. So the first one is the momentum, using momentum, and number 2 is trend line, and number 3 is stack area. Stack area is also called as the ranging area. Also, we already discussed about in previous videos the ranging market or sideways market, that is also called as stack area. And number 4 is round numbers. We are going to discuss about these 4 points, and we are going to use these 4 points to draw the strong levels in the market. So let's get into it. First one is the momentum. So what is happening here is you drawn a resistance line here, okay? You drawn a resistance line here. This is a resistance line you drawn, and market is starting. You can see the bullish, it's a strong candle, and it is coming weak. The bullish candle become very weak, and again it become more weak, and again become very weak. So even there is a resistance line or not, market is getting ready to reverse, okay? Even you draw a resistance line or not, it doesn't matter. Market is getting its momentum. This is called momentum. Market's momentum is getting weak by candle. So, and it touched the resistance line, the market is getting reverse. So this level is weak. Why this weak? Because even if you don't draw this line, market will automatically come to down, automatically come to reverse point. So this level is weak level. But in this case, if we see the candles here, this is a strong candle, this is a very strong candle, and this is a very strong candle, and market touched this resistance line and suddenly come back. So you are seeing this line is stopping the strong movement. This is a very powerful movement, and still it is reversing back. So this is what is called a strong level. This level can stop the market and can reverse the market. So this is called as strong level, and this is called as a weak level. You understood why this is happening? So let's move the another direction, that is support level. This is a support line you drawn already. Market is, you can see the candle is stronger, and it is becoming weak, and again weak, and again weak. The market is already ready to move a reversal pattern, and it touched here. So this is a weak level. And here you can see market is gaining its momentum and it's going very strong, and suddenly when it touches this line, it is immediately it's going back. So this is considered as a strong level because this line can stop and reverse the market. Even it is a very strong market, it can reverse. So this is called a strong reversal area. You need to remember and note down every single explanation in your notes. So first, momentum level is over, and number 2 is trend lines. So you draw a trend line like this. This is a point 1 and point 2. You taking 2 points and drawn a trend line. Okay. So after drawing a trend line, this is a 0, considered as 0. Okay. This is the 2 points you take in to draw a trend line, and after taking trend line, the first touch up line, this area is a very strong level of reversal market. Okay, this is a very strong level of reversal market. So for example, if you drawn and again market come back and may touch here the third time again, this is not as strong because market can break here or break here anytime. The market can break, but here it does first time attempt, because this is the first time, second time, and this is the first time attempt. After drawing a trend line, this is the first touch up, and this is a very strong level. So this is the trend line you can use to find the strong level. From this time, market can break out anytime. So this is the strong level you can find using trend lines. And number 3 is the stack area levels. You already seen this is a ranging market. Okay, market is going 1 2 3 4 like this, up and downs in the same areas. Almost everything is same. So you can see this is the first touch and second. In down it is a first touch, upside this is a second touch, in down it is a second touch, upside this is a third touch, downside this is the third touch, this is a fourth, and this is a fourth. And this can break anytime. Here it can break, or here it can break to down or up, wherever it may be. Market can break anytime, but whenever market is going in a stack area, the second touch, either it is upside or downside, the second and third touch is the very strong level. Fourth time that market can break out to up, or this can break to down, but this second time and third time is a very strong levels. You can take trades and consider these levels. This time is a very strong level. And number 4 is round numbers. I'm going to explain you this in a very easy way to understand. Okay, what are round levels? If you open a chart like this, here I can see there are a lot of values. 1.38100. You can see this is a 00, and there are a lot of numbers. This is the value of the price. Okay, this is the value of the price. If you see the market here, there are a lot of numbers. 3800, 388045, 38814705, like this. So these are price values of the market. So here I drawn the same thing here. You can see these are the price levels. Okay, the price levels comes in the form of odd numbers and even numbers. When you find some zeros at the end, okay, like 71.00 or 71.10, 50, 60, or triple zeros, 50, or 70.00, like this. If you find something like this is called round numbers. So for example, let me draw in whiteboard. Like for example, let's take a trend line. Okay, you drawn a trend line from this area like this, and another trend line like this. For example, the price lines look like this, right? Here, if you can see, okay, at this area, if the price value, for example, the market is 1.38129, something like this. Okay, so we are going to draw something like that. 1.38000, for example, like this. If we are ready to take the trades like this areas, because market is getting rejections, and at the same area if you find some round numbers like this will become a very strong level. Okay, this will become very strong, either it is an up trade or down trend. If you find any round numbers like this, if you find something like this here, it is a 1 point, for example, let's take 1.38765 like this, and let's take this area like 1.2000, for example, like this. For example, this is a round level, this is a round number level, so this area become very strong area. So these are called round number levels. You need to find, this is a not very important thing that you need to find the round levels in binary options trading, but if you want to get more strong level in the trading, that you need to definitely find this kind of round number levels, so that you can trade very effectively with very high accuracy. Okay, so these are the 4 things you need to remember, and you can use these 4 things to find the strong levels. You already understood. Let's revise one again. And finally, so number 1, momentum. You can find these are the weak market movement. So this is the weak level, this is the strong level, and at the same thing in the support level also. So this in trend levels, the first touch up after drawing the trend line, you will join number 1, number 2. These 2 lines you are going to join, and after this drawing the trend line, the first touch up will be the strong level, and in stack area the number 2nd and 3rd will be the strong level, and in round numbers every round number is a strong level. So if your level is matching with these round levels, you can consider it as a strong level. These 4 ways you can make your levels, you can draw your levels into the next level, and you can use them to make a lot of profits, and you can make a very good trades every time. So let's move to the main strategies of our price action, and we are also going to explain some candlestick patterns. You need to remember those patterns to make trades, because patterns always decide the future of the market. If you remember the patterns, you can easily take trades. So in next video we are going to discuss about the candlestick patterns, and you need to note down everything. After that we are directly jumping into our trading strategies, the $1 million strategy. In this video we are going to discuss and explain about some important candlestick patterns. Candlesticks create some patterns, some repeated patterns. There are thousands of candlestick patterns, but from those there are some important candlestick patterns that we picked up, and if you remember and follow those candlestick patterns, you can improve your trading style into the next level, and you can trade like a pro trader. So what are those candlestick patterns? Let's see that. So this is called hammer and inverted hammer. These candles are looking like a hammer. You already seen hammer in real life. So you are seeing here, it is a bullish hammer, it is a bearish hammer. This is a candles looking like a hammer, so this is called hammer pattern. And these are called inverted hammer pattern, also called as shooting star pattern. So this is a bullish shooting star pattern, and this is a bearish shooting star pattern. You need to remember this, take notes and clearly note down everything and remember everything. These patterns we are going to use in our trading. So let's move to the next pattern. This is called engulfing pattern. Engulfing pattern means this is a bullish engulfing pattern. So here you can see a bullish candle pushed into a long upside than the previous bearish candle. It given a very long push. So this is called a bullish engulfing. Engulf means a sudden spike. Engulf means in English it's a sudden spike and it's a long push. So it is a bearish engulfing. You already understood what I'm saying, because if you understand this, you can easily understand the opposite one. So this is the bearish engulfing pattern. You need to remember every pattern. And this is a piercing line. This is a piercing line, and the opposite of this called as a dark cloud cover. So what is piercing line? For example, I will tell you on the whiteboard here. So if it is a candle, for example, this is a candle, I'm filling up with, this is a, for example, this is a bullish candle. What the next candle will, where the next candle starts, here it opened. You understood, we already discussed about the candlestick opening price and closing price. This is, here market opens and here market closes, and the next candle will open from here. Where it closed, the next candle will start from that level. Okay, so here you just assume that this is a bearish candle and this is a close of this. I'm drawing for you. This is the opening, this is the closing, and where the market close, from that level the next candle will open. So this is the opening of the next candle, and this is the closing of the candle. And the next candle, where it forms from here, because this is where the market close, from that level the next candle will open. So this is the close. So from here, new candle open. This is the close, a new candle opening here. So let's take something here like this, and a new candle open. Where it opens, here it closed. So from here it opens a new candle. Okay, so you need to understand that, you need to understand that where market close, from that level a new candle will open. So here what happens in piercing line, I will explain you clearly. Okay, here you can see it's a bearish candle. Okay, it is a bearish candle. It is a bearish candle. The next candle should be open from here. Okay, either it is a bull or bear, the next candle should be open from here, right? Exactly at the same point, exactly from the same level of the previous closing. Okay, the levels are same. Okay, you can see it closed here, it opened here. But what happens in piercing line, I will tell you clearly. The bullish line will open from here. Okay, simply there will be a gap, there will be a little gap. You can see there is a little gap here. You are seeing a little gap here. You are understanding? Sorry, yes, the market should open from this level, from this level. But what happened here, market made a small gap down and open from this level. Okay, so here what is happening, here you can see it's a bearish, and market made a gap down and started from here. So here you can see it is a bearish candle. The market need to start from this level, but it starts from here. So there is a gap, here. If a bullish candle came with a previous gap down, that is called piercing line pattern, and at the same, just like same but in opposite direction, a bearish candle happens with the gap up, it should be start from this level but started from here. So this is called dark cloud cover. These are the some important patterns, and there are some other important patterns also there, that this is called doji pattern. I hope we already discussed about the doji in previous videos. This is called doji star. It looks like a star, so we call it as a doji. Doji has a no body, it just have a wings, and this is called dragonfly doji.
It looks like a T, capital T shape, and this is a gravestone doji. Okay, reverse of capital T, and this is a plus shape doji. This is called long leg doji. Okay, these are the doji important patterns, and this is another pattern. This is called morning star. This indicates the bullish market. Morning star means a bearish candle and a doji candle and a strong bullish candle. This is called a morning star. This indicates a bullish trend. So at the same opposite, it is a bullish candle and with a doji, and after that a strong bearish candle. This is called evening star. This indicates a bearish movement of the market. That means market is going to down. Here market is going to up. So these are the main important patterns. And last one is the spinning top. These both looks like same. This looks like a spinning top, upside wick and downside wick. These are long wicks. Generally the wicks will be longer than the body, with small bodies. Okay, with small bodies, upside and downside wicks. These are the spinning top patterns. Okay, these are the main important patterns you need to remember. We are going to use these patterns in our trading in further videos. So just remember once again, what are the patterns here? The pattern is hammer pattern and engulfing pattern, piercing and dark cloud pattern, doji, morning and evening stars, and spinning top. These are the important candlestick patterns you need to remember. Take notes and write down everything. Before going to the $1 million strategy, I am going to tell you two important things in the trading. So it is already explained in the previous time, but it is a little different. It is included with the candlesticks. So what are the candle breakout and retracement? Retracement is also called as rejection. Okay, so what is the breakouts and rejections? I'm just giving you a simple image here to easily understand. Okay, this is a key level. Key level means whether it is a support or resistance, or a trend line, or a round number, or whatever it may be. So here it is the key line, key level, whatever it may be. If a green candle, bullish candle, breaks that level and close outside of the level, here it is the line at market, the candle closed outside of this, so this is called a breakout candle. Okay, also in the same condition, if it is a bear candle, it breaks the key level and close outside of the level, that is called a breakout. It is a bullish breakout, this is a bearish breakout, and these are called breakouts, and these are rejections. Like, let me explain you. This is a key level. Okay, a green candle just broke in the level and went outside of this level, and again came back and closed it below the level. Okay, you understood? Here market started, went up to here and came back and closed it here. Here market started, came back and closed it here, closed it below the level, below the key level. Market started here, went and touched the level and closed it below that level. Here market started and went back and came back and stopped it here. So stop it here. So if the candle breaks the level and close below the level or inside the level, that is called rejection. What is rejection means? The price is not accepting. Okay, it is breaking the level like this and the price is not accepting, so it is coming back and closing inside the level. So this is called a breakout and this is called a rejections. This is called rejections. Here you can see the same conditions. Market went down and came back and stopped exactly on the level. It breaking down and closed it here inside.
breaking down, breaking here up to here, touched this line and closed it inside the level, came here and touched inside this level, closed it inside this level. So this is called rejections. So these are the breakouts, these are the rejections. So we are going to use these two things in our strategies. So before going into the $1 million strategy, I would like to explain about these things. So remember these things about the candlesticks. These are the candle breakout, these are the candle rejections or retracements. Okay, so let's move. Binary options $1 million strategy. Now you have learned all the basics about the market. You have learned all the concepts of the market. You have learned all the theories of the market. You understood what is the market, what is the trend, what is the levels, what is the candlesticks, everything. You know how to trade on the brokers and how to set the time frames and everything, how to draw the lines. You learned all the basic things that you need to understand, that you need to know. Now it is the time to learn the $1 million strategy. This is the doorway of your success. So it is the very important class for you. You need to take a notes and you need to listen it very carefully and make notes of everything. Learn it seriously and responsibly. Take it as responsibly. So it is a $1 million strategy. Generally it is not a single strategy. It has multiple strategies. You can master it and you can really make millions with this. And I personally made a lot of profits with these strategies. These strategies I developed in my 9 years of experience in trading in only binary options and forex trading. So I can apply these kind of strategies in my other kind of trading also. So make it everything clear and make your mind peaceful and start watching and learning it. Practice it. So let's jump into it. There is a secret of the price action. There are a lot of traders in this world and they can trade in their own style. But there is one of my secret of the price action. This is my secret of the price action. Maybe this kind of price action used by some of traders, but this is my secret of the price action. You need to know just 3 things in this. These are the 3 key points in the price action. You need to carefully observe. You just need to find out these 3 things. That's it. If you find out these things in the 3 things in this market, you can really win the markets almost every time. The first one is the market trend. You need to find the market's trend. And number 2, you need to find the pullback. I will explain you about the pullback. Okay, don't worry. And number 3, you need to find the trade entry level or strong level, where to entry. One is market trend, number 2 is pullback, number 3 is trade entry level. That's it. This is the main secret of this price action. Secret of my price action theory. So let's get into it. I will give you some examples in uptrend and downtrend. If you just look at that image, you will easily get the point. So let's jump into it. This is an uptrend example or up call trade example. For example, market is going in up direction. It is a market trend and it gives a little pullback. Pullback means even it is an uptrend market. For example, even it is an uptrend market, it gives a little slight backward direction also. I already explained to you that market never goes in a straight way. It goes with up and downs, a lot of up and downs. So that is called a pullback. An uptrend, if it gives a little opposite direction, that is called pullback. Okay, so the market trend is up and it given a small pullback, and you need to find a strong level. You need to find a strong level. If market touches that level and rejects, I already told you what are the breakout candles and what are the rejection candles. For example, market went like this and it given a little pullback and stop it at the strong level. Okay, this is a strong level. Stop it at and made a rejection here, and you can enter the trade here. It goes in this direction again. But if the market breaks this level, you don't trade that trade. Okay, this is the breakout candle. I already told you about the breakout candle. If the market breaks, we don't trade. Why we don't trade on the breakouts? Because more than 75% of the breakouts are fake breakouts. Those are just a manipulation. Those are not real breakouts. So that's why we avoid the breakouts trading. So what is I am saying here? Market is going up and gives a little pullback, and when it touches the strong level and gives a rejection, you can enter the trade. This is your strong entry point. You got it? So this is the formula of the secret price action. You need to find the trend and a pullback and a strong level. That's it. And this same applies on the downtrend also. So let's jump into it. This is an example of a downtrend. If market is going in a strong downtrend and gives a little pullback and stops at the strong level and gives a little rejection, you can enter the trade here for down. You should never go against the trend. If the market is going downwards, and you should never go for the call trade. You should never go for the up trade, because that is the against of the trend. If market is down, don't trade for call trades or buy trades. Only trade down trades. This is why, because lot of big traders go with the market and push the market. So you cannot fight with them. So just follow the trend. If you follow the trend, that same trend becomes your friend. Okay? So here the simple formula you need to keep in mind always, that every time you take the trade, first of all you need to understand, you need to find the market trend and pull back and trade entry point. These 3 points, these 3 key points can make you really $1 million of profits. And now in next videos we are going to learn how these 3 points are going to apply on with trend line and with SNR. SNR means support and resistance. We use, in the binary language, we use SNR. SNR means support and resistance. Just keep it in mind. Okay, keep it in mind. We use these shortcuts. I forgot to mention it in before. So we are going to apply these 3 things. We are going to apply these same 3 things in a trend line, in a SNR, and in candlesticks, and going to make a wonderful trades. So let's move to the next videos.
In previous videos, we learned about 3 main secrets of the price action. So what is that? Just remembering once again. Number 1 is finding the market's trend. Number 2 is finding a pullback. And number 3 is finding the strong entry level. And we are going to apply those rules, those secret keys in our strategies from now. So from those strategies, the first one is trend line secrets. This is not a normal trend line that you find as a basic lessons. This is not a basic trend line. This is some kind of advanced trend line secrets thing that you can use in binary options to make high probable trades. But it is very simple. It is just connecting 2 points, point A and point B. So if you connect point A and B and it gives you point C, and after the point C you are going to trade the option. Okay, it is very simple. Don't get confused. Take in notes and write down everything and listen everything carefully. It is just, as long as you watch the video till the end, you will understand the things very easily. So let's start. If a two green candles or a two red candles forms in a trend, connect them as point A and B. Okay, so here I will give you some examples you will easily understand. So for example, market is an uptrend. Okay, you need to find the patterns like this: one bearish candle, and after that two continuous bullish candles. One bearish, two continuous bullish, one bearish and two continuous bullish, like this. And in downtrend you need to find like this: one bullish candle and followed by two bearish continuous candles, and like this, like this, like this. There are various of forms like this, but you need to find this kind of pattern. What happens here? I will tell you something, that I'm going to draw something for you to make you clearly understand it. So just be patient. I will draw something for you. So the candles are going like this, and I'm going to paint something. Just be patient. And okay, the market, you can see what this market is looking like. This is an uptrend market. Why this is an uptrend market? Because market is going like this. Market is going like this. You can see market is going like this. So this is an uptrend market. And let's see something different. So what I said before is, in uptrend market you need to find a pattern like one bearish and two bullish candles. So let's check it out. One bearish and two bullish candles. So this is a pattern. Okay, and you can see this is a one bearish and one bullish. Don't take this. Don't take this kind of things. Okay, this is not okay. This is not. And you can see here again another pattern: one bearish and two bullish candles. Okay, so mark this as a point A and point B. This is a point A and this is a point B. Okay, this area is a point B. This is a point A and this is a point B. Okay, so you need to connect the point A and point B. That's it. Just connect point A with point B. Okay, so like this market will. So you connected the point A and point B with some candle patterns, and market again comes back to this. Let me take some other pencil to draw it. Take some other color. Okay, that's fine. So market went like this, point A and point B, and market again comes to this level and makes a bullish candle again. This is a point C. When market touches the same line again, so that is a point C. From point C, the market needs to go like same like previous. It should be go like a bullish candle, and you will enter after this candle close. The next candle will be, in most probable cases, almost every time, the next candle will be, the next candle will be a green candle for sure. So you need to trade here. You need to trade here exactly at this level. So you find a point A and point B and join them as a trend line. So when market comes again to the point and reverse back with a bullish form just like previous, and just you take the trade at this level after this candle close. So this candle will win. So let's same thing we already designed for you. So let's get into it once again to check it out. So here you can see you are going to trade buy trades or call trades. So here what is I exactly explained, the market is going in an uptrend like this. You can see clearly market is going in uptrend. Okay, you're going to trade only up trades. So here the pattern is formed with two bullish candles followed by a bearish candle, two bullish candles followed by a bearish candle. So this is the point A and this is the point B, and I connected the line here. Market came again to the point and it reversed back with a bullish candle. Here I will enter the trade. Immediately I will take the trade after this candle close. When the market closed this candle, I immediately enter this trade. This candle will be win. Okay, simply to make this simple to understand for you, I just given some points. Okay, just simply write down these points in your notes and draw some sample images like this in your notes. You can see, draw a trend line connecting point A and point B. You already know what is point A, point B, because I already told you that in uptrend you need to find a two bullish candle with followed by a bearish candle. So make this a point A and this is point B, just connect the line. And you need to remember one more thing, that point A and point B must not be less than two green candles. So sometimes market gives only one green candle. Don't take that. You need at least two green candles like this. You need at least two green candles. After a bearish candle, you need at least two green candles. If you have only one green candle and again red, then don't take those kind of patterns. Okay, so this is what you need to understand. And let's go to the next one. This is a sell trades. It is also same like that, but in reverse direction. So this is a downtrend that you can easily understand. Market is going like this. Okay, market is going like this, and two bearish candles followed by bullish, and another two bullish candles followed by bullish. So you just drawn by connecting point A and point B, and point C is formed. Market touched here and came back with a bearish. You are going to enter here again, and this candle will be win. This is a put. I already given some text for you to easily understand. Here, draw a trend line connecting point A and point B. Point A and point B must not less than two red candles, and here you will enter the trade, put or sell for 1 minute at this candle. So just same like buy options but in opposite direction. Here you will buy for 1 minute. Okay, so this is how you are going to trade, and I have taken some live trades for you and made it snapshots. You just to observe that what happened there. I will show you something. So here I drawn exactly what I explained in the real market. You can see here a two bullish candles followed by a bearish candle, and two bullish candles following by a bearish candle in an uptrend market. Okay, you understood? In an uptrend market. So I just connected point A and point B with the trend line like this. You understood? So market again reached that point C. This is the point C, this is the point B, this is the point A. Okay, so market touched back again and reversed back with a bullish. Okay, so here I entered the trade, and the next candle is won. It was a profitable trade. I won the trade. This is what I explained exactly. So let's see the next trade. Here you can see two bearish candles following by a bullish candle. and again two bearish candles followed by a bullish candles, two bearish with one bullish, two bearish with one bullish. And also the market is going in a downtrend like this. Okay, so this is a downtrend, and I found the two patterns. This is the point A and this is the point B. So I connected the point A and point B. Here I found the point C. You can see at point C market touched this line and again went back and formed a bearish. I entered the trade here from the next candle. This is a clear win candle. So this is what I explained in our theory. So let's take one more example of live trading. That this is, you can see here I already marked this for you. This is a clear two bearish candles, and here again two bearish candles. This is a point A and this is the point B. I connected those lines and the market again touched those lines at point C, and it came back and I entered the trade here. This exactly this level, I entered the trade here for 1 minute and market went down, and it was win and it was profitable trade. So this is how you need to trade. This is not a normal trend line strategy. It is a some kind of advanced trading strategy that I am personally using, and I am making a lot of winning trades with this. So let's move to the next strategy. Trendline secrets you already learned and you understood. I hope you understood. It is very simple strategy. You just need to connect point A and point B with candlesticks, continuous candlesticks in a trend. Okay, in a trend. So if you connect that line, you will get a point C. At point C, if the market gets in same direction, you will enter the trade. So this is my trend line secrets. In next video, you are going to learn how to draw the support and resistance in a very easy way to make very sharp entries of the trades. Okay, so let's move to the next video. In this video, we are going to learn about support and resistance secrets. You can find many support and resistance strategies or basic education about it in anywhere on internet, but this strategy is an exclusive secret SNR strategy provided by Binary Secrets and Stocktoppers. You are going to draw some horizontal lines on your chart to track your trades. Okay, it is very easy. If you learn the subject, it will be very easy for you, and it is very effective and very strong. Just follow whatever I'm saying. Just take notes and make notes everything and practice it more to become master in this strategy. This is a support and resistance secret, and in this strategy we are going to use a small technical tool that's name is Ichimoku Cloud. Its name is Ichimoku Cloud. So first learn how to install this Ichimoku Cloud. It will be available on any platform. Even if you use IQ Option, Olim Trade, Binomo, or any other binary.com or pocketoption.com, whatever it may be, you will find this Ichimoku Cloud in your platform for sure. But I recommend to trade on IQ Option. This is the best for me and for many others. So first go to the IQ Option, and at bottom left side you will find an option called indicators, and select it, and in search bar type Ichimoku. It will be displayed a Ichimoku Cloud option. Click on that, and here are the default values of 9, 26, 52, 26. Just keep it them as it is, and change the colors. We don't need all this, we just need two things. So we just need this lagging line and the cloud filling. So make everything no color, everything make them, just make everything okay, and just leave the cloud filling, don't change anything here. And here you can change this color. I'm just changing the color for white and apply this, exactly follow what I'm doing here. Okay, here the indicator is ready. So what it is giving to you, you can see there is some formation like clouds in the sky. So there are some green clouds, there are some red clouds. That means these are the Ichimoku clouds. Now at present market, it is going in a green clouds. That means market is in uptrend. Okay, market is in uptrend. And there is one line here, that is white color line, it's going like a waves. So what is this? It gives you a sharp levels. So let's draw some support and resistance using this. How to draw? Let me show you. The market, the white line goes like this. Sorry, it goes like this. And there are more waves like this. At some points you will find some sharp curves like this. This is a very sharp curve you can find. So, and you can find some other curves like this, very sharp curves like this. So you need to find those sharp curves. So let's find those. Let's zoom out a little bit, and you can see this is not a sharp thing, this is not a sharp one. And you can see this is a sharp curve. So draw a line here, okay, and draw another line at this sharp area, okay, and this is also is sharp area. So draw some lines, you are getting some. And here you can see at this point, this is also one kind of sharp area. So let's draw some line there. So you drawn some lines here. These lines are support and resistance lines. Okay, you don't need to find any low levels, high levels, and you need to check the charts, and you don't need to do all these things. Just using this indicator you can draw the support and resistance levels. So it is very easy to draw the support and resistance levels. And here there are a lot of sharp levels like this. Here you can see this is a sharp level. Here this is another level. Sorry, this is another level. There are a lot of levels available here you can draw with this indicator. So in this way you can draw the support and resistance lines, and you can trade by your own, in your own style also. So those who are struggling to draw the support and resistance lines, they can use this indicator to draw the SNL lines in a very simple manner, and you can trade very easily. So now let's move to the main topic. What is that? Let's go to that. You need to take a call trade, like call option. What is the requirements for that? The number one requirement is Ichimoku cloud should be in green color. So you can see for uptrade you need to have a green color cloud, and draw a support line at sharp up curve. So and when the market retouches and rejects that support, take trade. So what is here is when the market is going upward and the Ichimoku cloud is going in a green color, draw a line at the sharp up curve. This is a sharp up curve, so I drawn a line here. When market comes back again to this line, same line, and rejects, rejection means without breaking. If market comes here and breaks down, that is called breakout. But if the candle comes and closes inside the line, that is called rejection. So whenever I say rejection, that means the candle closed inside of the key level. So you drawn a strong level here and the market is in up moment. When market comes down to the same level and rejects from here, you can take for up trade here. Okay, in the same way you can take a down trade. Ichimoku cloud should be in red color and draw a resistance line at the sharp down curve. When market retouches and rejects that resistance, take trade. So take an example like this is so delete the previous one so you can understand it clearly. This is a red color cloud and the market is moving downwards, and take a sharp curve. Here it's a sharp curve. You can see here it is not a sharp curve. These are not the sharp curves. This is a sharp curve. Okay, this is a sharp curve, and this is also looking like a little bit sharp. Okay, so I'm going to draw something like this. So I'm going to draw another line here. Okay, so what I'm doing here, I just drawn a line here. Okay, you understood? I just drawn a line here. When the market retouches this level, that means it will go down. Here you can see the market retouched here. It is already downtrend. You've drawn a line, market retouched this level and stopped exactly on that level, and next candle is win. Next candle came down. Okay, that is a win trade. And same like this is also a sharp area. So you can see here the market went up, touched this level and stopped at that, and next candle is a clear win. So you need to trade like this. I will explain you in a little bit clearly on a whiteboard. So let's do it. So when the Ichimoku cloud, let's take some cloud. Okay, so when the Ichimoku cloud is in green color, so market, that means market is in uptrend. Okay, market is going in an uptrend direction like this, and you need to find a sharp curve and you need to draw a line. In uptrend, you will draw a support line. So market when retouches that line and rejects, you need to take in the direction of trend. What is the trend here? The trend is uptrend, so you are going to take a uptrend, up trade. So this is same as vice versa in the downtrend. In downtrend, market should be in a red color, Ichimoku cloud should be in red color, and you are drawing a line at the sharp down curve, and market when retouches that line and rejects, you will take a down trade. That's simple. I already explained you about the market's theory. What is the secret in the section of secret of price action? Okay, you will understand everything in that video. So what is essentially and ultimately happening here is market trend is upward and it is getting a pullback and again taking that trend. So you are entering at this place. It is in the case of uptrend. For example, market is going in downtrend, so this is a market downtrend and it gives a little pullback and goes again back, and here it is the strong level. You are entering at this level. This is happening all the time. This I already explained to you in the previous videos of secrets of the price action. Okay, so let's see something here. I given some other things like what is mean of the sharp curve. In uptrend curves there are a lot of curves. There are different kind of curves. Some curves will be looking like this kind and this kind and this kind, but some curves look like this. This is a very sharp curve. Select this kind of sharp curves to enter as a sharp trade, to enter as a strong trade. And in a downtrend, these are the normal curves which have no sharp edges, and this is the very sharp curve. Let's see some things on real market. So you can see, I will just point out some sharp curves. Okay, you will understand what is that means. Okay, so you can see here it is market curve, but it's not a sharp curve. But here you can see it is a very sharp curve. Here it is also looking like a sharp curve, but what happened here is market went like this and came back and is going in a sideways movement. But here you can see the market went sharp down, sharp up, and sharp down and sharp up like this. So if you find this kind of curves, this will be working as a very sharp level. So this is what I'm saying. Let's find some of the sharp curves. These are not sharp curves. I will show you the sharp curve. Okay, just wait. This is a sharp curve. You can see this is a very sharp curve. It's a clean and clear sharp curve. You can see there are some bends up and little bend and down and little bend. So don't consider this kind of curves. Take this kind of curves. These are looking very clean and sharp. So you understood the three things here. That is, you need to set the Ichimoku cloud indicator as I mentioned and draw some lines according to it. And when market retouches that same line and rejects, you will take the trade according to the same trend direction. And we are going to take some live trades here in this video. So let's jump into it. Here are some live trades for you. So here you can see it is a AUD CAD pair. You can see the market is going in a downtrend and the Ichimoku cloud is looking like a red. And I drawn a resistance line using this curve. I will explain it. Just take the trade first. I'm waiting. If the candle close inside this line, I will take a downtrend here. Downtrend. Yes. It's closed inside the resistance line, so I taken the downtrend here. Let's see. Let's wait for 60 seconds to see the results. Okay. How I drawn this line? Because you can see it say in this area you will find this is the sharpest curve. Okay, this is not a sharp curve, this is not a sharp curve, this is the sharpest curve like this. I will show you in a whiteboard. The sharp curve looks like this, so if you find a sharp curve like this, draw a line on that. Draw a line on that, and that will act as a resistance line. So I just drawn a line on that and I won the trade. So it made the profit. So here what you are doing is you are finding the market trend, and you are finding the pullback, and you're finding a strong level, and you are taking the trade, and it is win. It's a pure win. So here I take in a up trade, call trade just now. Why I trade this? Because market is moving upward direction. It's a strong upward direction and a little pullback to down. Also you can see there is a Ichimoku cloud is going in green color. So this is an uptrend. And here you can see the market made a sharp curves, V-shaped curves like this. The market made a V-shaped curves with a sharp end, and I drawn a line here. This is called as support line. So I drawn a support line here. Here you can see in this area, this market is making sharp curves. Okay, so I drawn a line here. When market retouches that level and rejects and close inside that level, then we can take the trade as a support level. So I taken the trade, and trade was profitable, and we won the trade. This is how you can trade every time. Most of the time you can win with this secret strategy. In this section, we are going to learn some candlestick secret codes. Okay, so you need to make notes of everything, because everything is very important, and you can make a lot of profits with these secret codes. We already discussed about some candlestick patterns in previous sections, so we are going to apply those candlestick patterns in our strategy. In this video, we are going to learn the first pattern of that is hammer pattern. So let's get into it. How to trade hammer pattern? Hammer is the reversal pattern. Reversal pattern means if market is going upward direction, suddenly it is moving down, that is a reversal movement, and vice versa. So here is the hammer, and the tip of the hammer's wick works like a support line, and the tip of the inverted hammer's wick works like a resistance line. But we don't mostly use this kind of support and resistance, because we already explained about the secret of support and resistance in last section, that you already learned the secret way of drawing the support and resistance and taking trades. So let's just learn how to trade the hammer pattern. Just make notes of what everything, just remember everything. These are the very secret patterns. And here you can see the market is going downwards. I will tell you one simple point here. This is the, for example, this is a key level. Okay, this is the key level. Key level means it is a strong support and resistance, or whatever it may be. It is even it's a weak support and resistance. It is a support and resistance. If the candle close above the line, this is the candle closing above the line, so you are going to take a up trade. Okay, if the candle closes below the line, you are going to take downtrend. The candle formation may be in a different ways that we are going to discuss now, but this you need to remember. If candle close above the line, you are going to take up trade. If candle close below the line, you are going to take a down trade. So let's get into the topic. Here it is the downtrend, and this is the key level. Okay, these are the key levels. I'm just marking it. These are the key levels. Okay, a market going down and a bullish hammer market, hammer candle closed above the line, so next candle will go up. Market going down and a hammer pattern came and closed below the line or exactly on the line, then the next candle will go down. And in its same downtrend, This is a very important. The market should go in a downtrend only. It is only downtrend with hammer pattern. And a bearish hammer pattern came and closed exactly on the line or above the line. So next candle will go up. And if it is closed below the line, next candle will go down. So exactly in a downtrend, what is the situation of the inverted hammer pattern? This is the downtrend with inverted pattern. This is the same market like previous downtrend, but here it is a not hammer pattern, it is an inverted hammer pattern, also called as shooting star hammer pattern. So if a shooting star hammer pattern appears here in a downtrend and closed above the line, the next candle will definitely go in up direction. If a downtrend in a downtrend market, you can see here it's a downtrend market. If a shooting star, or we also call as inverted hammer, if it is closed below the line, you can see the candle closed below the line or exactly on the line, the next candle will go down. So in a downtrend, a bearish hammer pattern appear and closed above the line or on the line, the next candle will go up. In a bearish trend, a inverted hammer pattern closed below the line, the next candle will go down. So these are the patterns you need to remember. And exactly these things, what is the situation in uptrend market? Here it is an uptrend with hammer pattern. Okay, the market is going strong up and a hammer pattern appeared and closed above the line. Next candle will go up direction. In the up movement of market, a hammer pattern appeared. These are the key levels. Okay, appeared and closed on the line or below the line, next candle will go down. In the up direction, you can see the bearish and bullish candles, hammer candles are almost same data of the market, so you don't need to worry about that. You can say this is the bullish hammer, this is the bearish hammer, but both are same almost. You don't need to worry about it. So in an uptrend market, a bearish hammer appeared here and closed above the line. You can trade for uptrend, up market. And a uptrend, the market closed below the line, so next candle will go down. And in uptrend, what is the situation of the inverted hammer? Here it is also same like previous. In uptrend market, a inverted hammer appeared here and closed above the line, next candle will go up. In up market, if inverted hammer pattern closed on the line or below the line, next candle will go down. In uptrend market, a inverted hammer, either it is a bearish or bullish. This is a bearish, it is appearing here and closed above the line or on the line, and next candle will go up. And it is an uptrend market and a inverted hammer pattern appeared here and closed below the line. Here it is the closed, next candle will go down. So this is what is happening. Okay, next candle will go down. These are the patterns, these are the secret of hammer patterns. If you find any hammer patterns in your market, you can trade like this and you can get most probable winning trades all the time. So let's move to the next candlestick pattern with some secret codes. This is the second number of patterns in candlestick secret codes. This is called engulfing pattern. We already discussed about the candlestick patterns in previous section, so we don't need to discuss about this kind of patterns again and again. This bullish engulfing means engulfing means a large spike. Okay, when market suddenly goes in a larger spike than the previous trend, that is called engulfing. Okay, so the bullish engulfments, after the bearish candle, it gives a big push up. After a bullish candle, a big push down, that is called bearish engulf. So how to trade this engulf pattern? There are some secret codes of this. Just let's finish that. Just understand the concept. So in a bullish engulf, first discuss about the bullish engulf. if this is a bullish engulf, just draw a line here. This is a bullish engulf, and this is in this candle before there will be a bearish candle. So draw a line here and end of this line. These lines works as a SNR level. We are going to use this SNR level. Okay, we are going to use these SNR levels. Okay, so what is happening here is you need to draw lines here at this bearish candle, opening price and closing price. Okay, you need to draw lines, and after drawing these lines, what you need to do, so here you can see it is the market of downtrend. Market is going in a strong downtrend, and here I got a bullish engulfing pattern. Okay, and in these areas I drawn two lines. I mean the opening and closing of the bearish candle here. These are working as a support lines. Okay, these are working as a support lines. And after this, what you need to do, so you need to wait, we need to wait for a retracement. So after this candle, you drawn the lines in a downtrend. A market will goes in some moments, or after one or two candles, a small candle will come up and touches this line and close above the line. Okay, not close below the line. If it close below the line, that is called breakout. Okay, so in a downtrend I got a bullish engulfing pattern, and I'm just getting a retracement candle. A candle will come and touch this, which line, this line, touch this line and close above the line. Okay, if it close above the line, what will happens, the next candle will go straight up. Okay, trade here, you need to enter the trade here exactly after this candle close. Once this candle close, you need to trade exactly immediately here, and next candle will go up. Okay, if the candle close below this line, don't trade that. Okay, if candle touches and close above the line, then you have to trade. Okay, you need to understand. And what is bearish engulf? This is the bearish engulf, and you need to draw a SNR level with the previous candle. This is the engulfing candle, and this is the previous candle. So opening and closing, this is the closing and this is the opening. You drawn two lines. Okay, and you got a support and resistance lines. And with that, it is an uptrend, a strong uptrend, and I found a bearish engulfing pattern. Okay, and I drawn the lines which is acting as a resistance lines. Okay, and after what happened, I'm waiting for the retracement candle. A retracement candle comes and touches this line and rejects and close below the line. It should close below the line, not above the line. And if it close below the line, we will take the trade. If it close above the line, we don't take the trade. Okay, if it close below the line, the next candle will go down for sure. This is what is the secret behind the engulfing patterns. So I'm combining the both and explain you the things. The market is going in a downtrend, and I found a bullish engulfing pattern here, and a candle appeared here and retraced at this level, and I'm taking the trade. This candle is win. And after some moment, market went a strong up direction, and here I found a bearish engulfing pattern and a small retracement. Here market closed below the line, here market closed above the line. So if it breaks, if any candle breaks the line, that is called breakouts. If any candle touches and close below the lines, that is called rejection, also called as retracement. I already explained you about this. So market closed above the line, that is called rejected, that is called retracement candle. If a retracement candle appears, you can take the trade above here. This is a winning candle and this is a winning candle. This is how you need to trade with engulfing pattern, and this is the secret of engulfing pattern trades. Here are some key points that you need to remember. Don't take the trade immediately after engulfing pattern created.
this is engulfing pattern here. You don't need to take the trade here. You need to wait for the retracement candle for sure. Don't take the trade immediately after the engulfing pattern. Wait for the retracement candle. This is what I'm saying. And wait for the retracement candle. If it touches and rejects from the key level with the weak bullish and bearish form, then only you have to trade. Otherwise, if the level broken, don't take the trade. I already said that if the level is broken here, we don't take the trade. If it touches and rejects back, then only we go for the trade. And also there is one more important thing, that this retracement candle should be in a small body. This retracement candle should be formed in a small form. If it appears in a big candle, don't take the trade. That's simple. So you understood how to trade and what are the secrets behind the engulfing pattern of the candlesticks. So let's jump into the next pattern. In this video, we are going to learn about the third number of candlestick secret codes. Okay, this name is piercing line. How to trade piercing line pattern. So we already discussed about this piercing line pattern. For example, this is a bearish candle, and in a bearish candle, this is the market goes from up to down. So if it is go to up to down, the market starts here and ends here. Okay, so in this way, this is the opening of the market and this is the closing of the market, or opening of the candle, closing of the candle. How a next candle will open? Next candle will open exactly at the closing of the previous candle. If it is next candle also a bearish candle, for example, so it opened exactly at the previous closing. Or for example, next candle is a bullish candle. It opens at the same place. Okay, it opens at the same place and makes a bearish form. So what is happening here? It is the market opens exactly at the previous closing point. Market opens exactly at the previous closing level. Okay, but in piercing form, for example, I'm just taking an example. Here a bullish candle happened, but what has happened here is market open here. This is what happens in a piercing line. Market should open at this place but open here. So what happened here is a gap happened. You got a gap. This is called a gap down. This is called pierce line. A bearish candle formed here, and after this bearish candle, a bullish candle should come here. Exactly at this level. Exactly at this level it should come. Okay, but here market given a small gap and open at this level. This is called, and this bullish candle crossed more than 50% of the previous candle. This is the 50% height of the previous bearish candle, and it made a small gap down and crossed it bit more than the previous 50%. This is called a piercing line pattern. It is very simple to remember. Just I'm explaining you for deeper understanding and easily to remember. So what is happening? This is the open with the gap. This is called piercing line. And how to trade this piercing line, I will tell you. For example, market is going in a downtrend and you found a piercing line. Here I found a piercing line pattern. You can see the market opened with a gap and it crossed 50% of the previous candle. So this is considered as a piercing line pattern. So that 50% level is working as a support line. Okay, this is working as a support line, and I'm waiting for the retracement candle. When candle comes and touches this line and close above the line, that is called rejection. If candle rejects, and you are going to trade for up direction in the next candle will go in up direction and you are going to win. Exactly, it happens in a reverse mode in a downward direction. So before going to the downward movement, let's remember some key points about this. After a pretty long downtrend found piercing line pattern, so here it is a downtrend, so you need to find the piercing line pattern in a downward direction. After a pretty long downtrend found
piercing line pattern, then wait for the retracement from the key level and place a call trade. If candle broken the key level and no sign of rejection, then don't trade. Wait for the second time. It must come to touch the key level and retrace from the key level, then you can place the trade. So what I'm saying here is, if the market here in a downtrend you found a piercing line pattern and market rejects here, and next candle will go up. If this candle breaks this level to down and close it below the line, don't take the trade and wait for some time. Maybe market again go back to up and comes back again to the same level. For example, it broken down, so just wait for a few minutes and it will go up again and comes back again like this, and touches and rejects from here again. Then you can take the trade here. So wait for some time and wait for the rejection. A retracement candle is must. Without this retracement candle, you should not trade. Okay, and let's go for the dark cloud cover. This is the opposite direction of the piercing line pattern. So you can see a bullish candle happened, and here the market should open, but market opened here, the candle opened here, it is opened with a gap and crossed more than 50% of the previous candle. This is called dark cloud cover. Okay, so in uptrend direction I found a dark cloud cover pattern. You can see it crossed the 50 level. This 50 level working as a resistance line. Okay, this is working as a resistance line, and I'm waiting for a retracement candle. A retracement candle comes and touches this line and rejects back. It should not break, it should come and close back, and next candle will go down for sure. And the key points here are, after a pre-long uptrend found a dark cloud cover pattern, then wait for the retracement from the key level and place a put trade. If candle broke the key level and no sign of rejection, then don't trade. Wait for the second time. It must come to touch the key level and retrace from the key level, then you can place the put trade. So these are the ways to trade the piercing line and dark cloud patterns. These are the secret codes behind this. In every pattern we are following the simple price action secret formula, that we are finding the market trend, and we are finding some pullback or rejections, and we are waiting for the entry point, and we are taking the trade. These are the secret of price action. So let's move to the next pattern. How to trade doji. There are different kinds of shapes in doji. There are 4 main different kinds of shapes. That is, if doji looks like this is called doji star. Okay, this is called doji star, and this is called a dragonfly doji. This is called gravestone doji, and this is called long leg doji. We already discussed it about in previous sections, but we also told that it is not so important candle pattern. So here the upper tips and lower tips works as a resistance and support in this doji pattern, but we don't trade on doji because its strength is medium. Here the doji means market has not taken any decisions yet. Market is in confusion state and not taken any decisions, any directions, so we cannot assume perfectly here. So let's move to the next useful pattern. We don't trade on doji candlestick patterns. If you find any doji patterns, just avoid that. So let's move to the next pattern. Here in this video we are going to learn about the morning star and evening star pattern. Okay, the morning star represents the bullish movement of the market. The evening star represents the bearish movement of the market. So when a morning star appears, market goes in up direction. When evening star appears, market goes in a down direction. So here a morning star means a bearish candle with a small doji, and after a bullish engulfing candle. These 3 combined called as morning star. And a bullish candle, a small doji, and a bearish engulfing candle. These three combining called as evening star pattern. So after this happened, draw some lines here. In bearish candle, draw a line here, and here in doji, take a line of upper doji tip and lower doji tip. So you need to draw these three lines. Okay, these three lines works as a SNR level or key levels. As same as here also, it is, you can see, you have to draw a line of the opening of the bullish candle, and here it is the doji. You need to draw a line of upper wick line and lower wick line. So here you need to draw the lines like this. After drawing the lines, what will happen and how to do it? So in a downtrend, you will trade with a Morningstar pattern. It is a market downtrend, and I found a Morningstar pattern here, and I draw some lines here. These lines works as a support lines, okay, support and resistance also sometimes. And I'm waiting for a retracement candle as same as the previous times, and it will touch this line and close above the line, and what happens, the next candle will go up. This is simple like the previous candlestick secret codes. And if it is a evening star pattern, it appears in uptrend market, and I draw the same lines, and you can see the market has a small retracement pattern. This is the evening star, and this is a retracement. I made some mistake here. This is a mistake of printing. So what should be here is, this is the evening star pattern and this is the retracement candle. Okay, so after this retracement candle, the next candle will go down, and it is also same like the previous candlestick codes, and you need to have some key points, like if the candle breaks this level, don't take the trade. Even in evening star or in morning star, if candle breaks this level, don't take the trade. If it rejects from this level, you need to take the trade. Okay, so what is your understanding here? Last we have explained the few secret codes of the candle. Everything looks like a same, right? You are just assuming that everything looks like a same. So what is the difference? There is a difference. You have to understand that you are learning here how to draw the levels. Okay, you are learning how to draw the levels. If you, for example, in a Morningstar pattern, if you draw the level here, for example, you draw the level here, and the market touches this line and rejects, if you take uptrend, it will fail and it will lose. If you draw the line exactly here and market rejects from this level, then next candle will go in up direction. So here what you learned in a secret course is, you are learning to draw the perfect reversal levels. Okay, once you draw the levels, you are waiting for some candlestick formation with some patterns and rejections, and you are taking the trades. That's it. So these are the things. And in last section, we also discussed about another candle pattern that is called a spinning top. Spinning top candle looks like this. Let me show you. A spinning top candle looks like this. A small body with a big wick. Okay, a big wick. A small body with big upper and lower wicks. Okay, this will looks like, this is a spinning top. Okay, this is a spinning top candle. We are not taking the spinning top candles because spinning top candles also indecision candles. We are not taking the indecision candles. Indecision candles we are going to avoid. What are the indecision candles? Those are doji candles are the indecision candles, and the spinning tops also are the indecision candles. So we are not taking the trades of spinning top and dojis. So these are the main candlestick patterns that you need to remember. If you don't understanding anything, just pause the video and just watch the image once. You will understand every single point. You don't need to worry about these things. Just practice these patterns as more as possible and you will make a lot of profitable trades. Okay. How to find good market moment? We trade in different time frames, different time zones around the globe. So many times you cannot find a good market. Your trades goes against your analysis many times. So how you can find the good market and you can avoid the bad market? So in this video, I'm going to tell you how to avoid the bad market. So here in current moment, the market is running in a bad moment. So how can you consider that it is a bad moment? Because there are the lot of wicks. You already know what the wicks are. Wicks are the shadows of the candle. There are long wicks. Here you can see from here to here, there are a lot of wicks. Every candle has a lot of wicks. The wicks are more than the body of the candle. So when you're finding a lot of wicks more than the body of the candle, that means market has no clear decision of the movement. Market has no clear decision and bulls or bears are in confusion state. They're not taking any decisions and market not any going any moment. You can see market going up and on the same candle it is coming down. So what is the good market then? So let's take it at here. You can see here, from here you can see the market is making some strong candles. So these are the good market. Okay, for example, I will show you some more examples. You can see here also market has the wicks, but you can see wicks are very less. Also wicks are shorter than the body. The bodies are bigger and wicks are very smaller here. So this is considered as a good market. You can see in this area it is not a good, it is a consolidation area. Market is getting its stack. It is not moving anywhere. It is going up and down at the same candle. So it is not a good area. This is a good market condition. You can see market is going in a very good market condition with a very high volume. So you can see here it is also market is going very nicely, going up and clean down, clean up, clean down, and up and downs like steps, like a ladder. It's going up very nicely. This is very nice moment of the market. Here you can see market is going in a very good moment. You can see, and if you find sometimes the market is running in OTC at this moment, and if for example if you open any other kinds of pairs, these are closed now. Just look at that. You can see there are no body of the candle, no wicks of the candle, nothing here. So market has no volume here. It is considered as a very bad market. So you can see there are wicks are very heavy here and the bodies are very smaller. You can find a lot of market situations like this. So whenever you find this kind of market situation, just avoid them and just trade on the healthy market moment. And I'm going to give another tip to easily find the best trend momentum of the market. So let's go to the indicator section in the IQ option. Just here in the indicator section, just go to the search bar and type MA. Okay, this is called moving average. Click on it. Once you click on it, it will there are a lot of options inside it. SMA stands for simple moving average, and WMA means weighted moving average. EMA means exponential moving average. Like there are a lot of kinds of moving averages. We just use the simple moving average, also called as SMA. Okay, just click on this and type 50, the 50 period momentum. Okay, and select the color of it is is a white. Okay, so white, make it a little bigger and apply on it market. So here you can see when the market is downside, I already told you that this is the good market, it is going down. So you can see market is going under this line, that is called a downtrend. Market is going upside of this line, that is called uptrend. But this simple line is not enough to determine the market trend, so I'm going to add some other tool like this. So add one more MA moving average. Okay, just click on moving average and select here that is 20. Okay, this 20, and click on this as a green color. Okay, apply it, and again go to the indicator section and find another MA that is 100. Okay, this is 100 moving average, and click on the red. Okay, keep on red and make it as bigger line. So you can see I will show you a very best moment of the market with this indicators. Here you can see when the market, I will explain you in the paint section. For example, you can see there is a red, white and green. Okay, so a red and a white that doesn't appear here, so I'm making this chart as a black color. Okay, so this is the market, and I'm going to use this white, and what is the next color is the green color, right? So this is green color. If the market is going, if the indicators are going in this condition, that is called a downtrend. So always consider red color is a downtrend. Okay, red color is a downtrend, and here green color is a uptrend. So if red, here the red color is in up hand, I mean it is in a top, the red color is in top and green color is bottom, that means the red is in power. If the red is in power, that is called a downtrend. Okay, so this is a downtrend. You can see on the live chat that red, white and green, this is a, from here to here the market is going in a down moment, and if you check it here you can see it's a beautiful moment of the market. Red, white, green, it's a clean market downtrend. Okay, market downtrend, you can take a lot of sell trades here in this moment. So here you can see at the same condition, the simple opposite, take a green candle, green line and a white line and a red line. If you see the indicators in this position, this is called a uptrend, right? This is called an uptrend. Why? Because the green color is on top, so this means the green color is in power. If the green color is in power, that is called uptrend. So let's find some other things like uptrend. Here is a clean uptrend, and you will find a lot of uptrends like this. This is a clean downtrend, and you can see this is a clean downtrend, a red, white, green, and here you can see red, white, green, I mean upside green, middle white and downside red. This is a clean uptrend. So like this you will find a lot of trades available here. So, and what is the bad market conditions that you can find? If the market is going like this, jingle, like this zigzag, like you can see, you are not finding any clear trend here. Market, sometimes the green is coming in middle and green is going up, and red is coming in middle and it is going down. A lot of confusion happening here with this indicator. So don't trade in these conditions because the market is not clear. These indicators will tell you the market's trend with clean momentum of good market. So here you can see the market, you need to at least gap. You can see what I'm saying here is, you can see there is a lot of gap here. From red color to green color, there is a gap. So you need to find this kind of gap. If the market is going in a in a small difference, like this is green and red and white, this is not a good market and this is not a good market. You need to find with clean gaps, with clean parallel lines. So if you find this kind of lines, you will easily find the good market. Okay, and you can easily trade with that. You can see this is a very clean market from here to here, and this is a very bad market. This is also not clear, this is not clear, and this is from here to here. The market is an uptrend, a clean uptrend. This is not clear, this is a clean uptrend. You can find a lot of market moments like this. So let's jump into the next video that you are going to learn many more things that will be using in your trading. So in this video you learned about how to find the good market and how to avoid the bad market conditions. A few things that you need to observe before every single trade. For example, you are going to take an up trade, a higher option. So from here, before taking this trade, you need to observe few things. Number one, I will show you here. Number one is the major trend. Okay, the major trend. For example, here the major trend is market is going upward direction. For example, I'm drawing some lines here. This is the market line. From here, market is going in up direction. Still the market is going up, so the major trend is up direction. And what is the minor trend? The minor trend is also called as pullbacks. Okay, pullbacks. So where is the pullback? From, I will draw some line, you will find that easily. From here, market is in a continuous upward direction. Market is in upward direction from here to here, and it is a little minor trend from here to here. It's a minor trend, also called as pullback. And you can see from here the market is again going up, went up from here to here. So you can simply that this is another level. So market started going up from here and given a little downtrend, and from here to here. Here what you need to understand, this is the point one you need to observe. What is the major trend? Uptrend. And what is the minor trend? Is a downtrend. You will take the trades like this. When the market goes up, in the previous sections we already discussed about this. If the market goes up like this and gives a little trend, little pullback, and you will find the strong level, here you will enter the trade and the market will go again to up, right? Here market will go again up here from here. So this is the strong level, you need to take the trade here. So for this is the major trend, this is the major trend, and this is the minor trend. And number three is the strong levels. Strong levels. Okay, so these 3 points you need to remember before every day, before every single trade you take. Here what is happening here, market going in up, it is a major trend is uptrend and minor trend is downtrend, and present market is going in again uptrend. So if for example I found the strong level here, I will enter. For example, I found a strong level here at this point, I will enter to trade. For example, market is going in up direction, market may go up because market major trend is up and market pullback is down, and we will find some best reversal area, I mean best strong levels, and we will take the trades accordingly. So these 3 points you need to remember before every single trade. And number four is the money management. And money, how much money you are investing. You need to remember this, how much money you are investing. For example, I have $100. On each trade I will invest 5%, so that means $5 on each trade. In money management section, you will understand every single topic about the money management, how you can balance your money and how much money you need to invest. You will get every information about the money management. So these 4 points you need to remember every time before taking every single trade. Number one is the major trend. What is the major trend? And what is the minor trend, that is pullback? And what is the strong, where is the strong level, and how much money you are investing on each trade? These 4 points you need to definitely remember before every single trade you take. Money management plays a very major role in trading, either in a stock market or forex or crypto market or binary options market. Money management is a very major thing and it is very essential. Okay, so you need to make it very strictly, because the trading plays with your emotions. If you start making money, I mean winning trades, you will get excitement and you will put more and more money. And if you start making losing, then also you will start investing more and more money to recover the losses. So in this way, at the final level, you are going to lose all your money every time. Therefore, you need a money management plan. If you make this money management plan very strictly, at the end of the month or at the end of the week, whatever you take, at the end of the time, you will be satisfied with your profits. Okay, so what is it? Let's check it out. I recommend you to invest 2% per trade from your balance. Whatever balance you have to invest maximum 2% from that in your trading. Okay, each trade. For example, if you have $100 in your account, okay, if you have $100 in your account, you have to invest 2% on each trade. Okay, that 2% means $2 per trade. This is how you need to trade. Some people can ask me that if I have a $20 or $30, how can I put, for example, if I have a $20 and I cannot go with 2%, because the 2% from $20 is around I think it's a 0.2, something like that. So we cannot invest 0.2 on a binary options, because the minimum amount we can invest is $1. So people can ask me that how can we trade with 2% if I have less than $100? I can suggest them, if you don't have $100 of balance, you have to keep practicing on demo until you get the $100 real money. The minimum amount that you can start on binary options, this is the best amount you can start. If you start with less than $100, there will be no use. You cannot recover and you cannot manage your money. So the minimum, it is the best investment plan that you can start with $100. And daily keep a target of 10 trades. Okay, daily just trade 10 trades. After 10 trades is completed, don't trade again up to the next day. Okay, maximum it takes 1 or 2 hours to complete 10 trades, or even sometimes 3 hours it takes. Maximum you will trade only 10 trades per day. If 10 trades is over, you will never touch the market again and you will come again tomorrow. Our strategies that we already explained to you can give you 80% accuracy. 80% means almost 8 out of 10 will be profitable. If you trade 10 trades, almost 8 trades will be win, and you may lose 2 or 3, something like that. Okay, you need to practice the strategies on demo account before starting on real money. Okay, that is you need to follow. So for example, I am taking some 3 probabilities here. You have to trade 10 trades in a day with fixed amount. Fixed amount means, as I said earlier, 2% per trade. 2%, even if you lose the trade, even if you win the trade, that doesn't matter. You have to trade only with 2% per trade. Okay, you have to trade only 2% per trade, total 10 trades. For example, if you win 7 trades out of 10, okay, that means 7 wins and 3 losses. So 7 minus 3, the total wins you got is 4 winning trades. If you have 4 winning trades and you invested 2% on each trade, and you are getting 8% profit added to your balance. If you have 8% return, that means in $100 balance, 8% is $8. Okay, $8. This is a approximate value of returns. Maybe you get some less or more, but this is an approximate value that I'm just giving you for the example how you can design your money management plan. So this is the another probability, that if you make 8 winning trades out of 10, and that means 8 wins and 2 losses. So 8 minus 2 is 6 winning trades in total. And 6 winning trades, each trade you invested 2%, and total 12% profit added to your balance. So 12% means in $100, that is $12. Okay, so if you make $9, as same as the previous, if you make 9 wins and 1 loss, that is 9 minus 1 is 8 winning trades total. So 8 into 2%, that is 16% profit added to your balance. So 16% means it is $16. So you think this 16 is very less. Okay, this is not less. Making 16%, on average you are making a 10% returns per day. Okay, a 10% return per day. 10% return per day is not a simple thing. You think that $8 is very less, but you need to remember that how much you started. You started with $100. You started with $100 and made $8 in one day. That is a very big money. For example, you started with $1,000. You would make $80 per day. The average. If you started with $10,000, for example, you'd make $800 per day. 800 per day is not a less money. For example, 800 into 30 days, it will make a lot of money. Okay, you understood? So in this way, I'm just assuming and I'm just explaining you for your better understanding. There is a chances that you can win 10 out of 10 trades also. So if you make 10 out of 10 trades win, you will make 20% returns in a single day. So on average, you will make a 10% returns on each day. That means for every 10 days, your investment will become double. If you start with $100 and if you trade it for 10 days, your investment become your balance become $200. So like this, if you start with $100, you will start making money, a decent money every month. Okay, and you need to increase your stakes every month, increase your investments and increase your balance every month. And this is a strict money management plan, and it will give you a decent amount of income. So, and along with this profit management, we also have to manage the losses. That is called stop loss. It is very essential in every trading, either in forex, crypto, stocks, whatever. So stop loss is very needed, because if you start losing the money, your emotions get impact on your trading and your mind says that invest more on next trade, invest more on next trade, invest more on next trade. So in this way, it is a losing streak. For example, you are losing continuously, and if you are not stopping and you are start making more and more trades, you will lose all your balance. So to avoid the losing streak and emotional impact, you have to keep a stop loss. So what is the value of stop loss? If you lost 3 trades continuously in a row, first trade you lost, second trade you lost, third trade you lost. If you lost 3 trades in a row, then just stop the trade blindly. Don't think a second thought. If you lost 3 trades in a row, then just stop the trade for that day and start again tomorrow, because there are more reasons that you get 3 trades in a row losses, because you may be in stress, or your mind is not good, whatever it may be. Your strategy is, you are not following the strategy well, or the market has a news impact or some other extra manipulations, whatever it may be. So if you started losing trades continuously 3 times in a row, then just stop the trade without any second thought. That is called stop loss. If you lost the trade, how much you will lose? The 3 trades, for example, 3 trades you lost and 2% on each trade, that is just 3 to the 6. Just 6% you lost. That's $6 you lost from your $100. That's it. Okay? Even it is a big amount, but you just lost $6. That is your stop loss. And again tomorrow come again and make again 7 winning trades or 8 winning trades, and you can recover all your money and you can make some more profits. So whenever you will hit 3 losses in a row before the 10 trades, just stop the trading and start again tomorrow. This is money management and stop loss matter. You need to remember it very strictly and follow it very strictly, because without the money management, you can never success in trading. So everything is ready for your freedom lifestyle. How is the freedom lifestyle? Because everything you have already learned, that you learned about the markets movements, you learned about the candlestick psychology, you learned about the price action levels, you learned about the candlestick secret codes, you learned about the $1 million strategies, money management, you got the tools, and you have everything. Now you have the freedom of trading. If you sit in front of the screen now for the trading, you have the complete freedom, because you have all the set, all the kit. You have the freedom of trading. If you have the freedom of trading, you will trade peacefully. If you trade peacefully and clearly with the cluster clear, you will make good trades. If you make good trades, you will see the profits. If you get the profits, you will lead a very freedom lifestyle. So a freedom of trading leads your freedom lifestyle. So this is why I said this is all the set for your freedom lifestyle. You learned everything. Take it very seriously and dedicatedly. You will become a very successful trader, and you will build a career in binary options trading. So all the very best for your trading journey, and I am wishing you a very good luck.